The venue used to be the bustling trading hall of our stock exchange since 1986. At its peak, hundreds of trading desks were arranged in concentric circles, and nearly 1,000 dealers were donning bright red vests jostled on red carpets. This is also hundreds of enterprises strike the iconic gong to set off their listed journey. When the last trading desk walked into history 7 years ago, the trading hall was given a new name, a new life in this Connect Hall, which is named after the Stock Connect program between the mainland and Hong Kong stock exchanges. And only 2 days ago, we were here celebrating the 10th anniversary of Stock Connect in this very hall. For the Hong Kong market, the past decade has been a remarkable journey of transformation into a super conduit of capital between mainland China and the rest of the world. So good old memories aside, I believe this hall embodies the irresistible changes and forces of change that constantly drive our capital markets forward. In global markets, the many forces of transformation have continued to reshape our market practices, growth strategies, and also regulation. As leading investment managers, you have a knack for identifying evolving market trends to stay ahead, seize opportunity, and keep both your firm and your clients out of harm's way. And my job as a regulator shares a similar purpose: to adapt to the shifting landscape through an agile and proportionate regulatory regime. So let me just check off a few forces of change in the investment landscape. First, innovative technology is sending the financial industry into a blue ocean of endless possibilities. Algo trading, machine learning, and AI language models combined are reshaping front, middle, and back offices function, including sales, research, client communication, and compliance. You can put in this bucket the nascent wave of tokenization that allows all of primary issuance, transfer, ownership, and record keeping of traditional financial products to be done on-chain at near atomic speed. Second, the rise of passive funds versus active funds has continued. Over the past 9 years, passive funds have attracted more inflows than active funds. For the first time, total assets in US passive mutual funds and ETFs have surpassed those active ones this year. This trend is also turning a bright spotlight on the vulnerability of investment concentration in the biggest corporations, where popular trades drive up their market caps and hence market index weighting. This creates a positive feedback loop. Once these popular trades unwind, the swing could be unforgiving. Third is the rapid growth of private market on the back of a more regulated banking market. Estimated assets under management for global private capital are as high as $14 trillion, which triples from a decade ago. It's growing the fastest in the US, followed by Europe. In Asia, its growth has been slower, which means greater upside potential. We think private credit should be supported as an alternative form of financing for enterprises and projects with a longer investment horizon. But there should be adequate transparency, liquidity risk management, as well as more data reporting. Then there is climate change, transition finance, and the list goes on. But my last point is that we are living in an era of predictable unpredictability. Thanks to technology, algo trading, and index investments, today's markets are far more concentrated, moving greater amounts of funds at faster speed across more diverse asset classes and geographies. Throw into this mix geopolitics and Trump 2.0. We know the supply chain disruptions, trade disputes, and military tensions in the past few years are not an aberration. Uncertainty and market volatility are the new and only certainty. Coping with the flux of this new era is akin to bracing for the trials and tribulations of a triathlon, arguing the most toughest sport. Unlike a 100-meter dash, a triathlon, which brings together swimming, cycling, and running, requires more grit than sheer power and speed. The triathletes must go the distance and overcome every obstacle along their way, be it torrential rain like today, tidal changes, or treacherous slopes. Hence, we must think and train up like a triathlete for agility, strength, and resilience to sail through the changes of our times. So thank you very much, and here we shall begin.
Thank you so much, Julia, for that welcome and setting the scene for us today. I'd now like to invite the Honourable Mr. Paul Chan, Financial Secretary of the Government of the Hong Kong Special Administrative Region and Honorary President of the Hong Kong Academy of Finance, to give his keynote speech. Please give Mr. Chan a warm welcome.
Thank you, Karen. Julia, Kelvin, Eddie, distinguished guests, ladies and gentlemen, good morning. I'm delighted to join the second day of the summit and take part in this conversation with global investors. In a world beset by uncertainty, we are all eager to identify and harness major emerging trends that will drive growth and prosperity. This morning, we look into a range of such potential pertinent trends, from the prospects of alternative assets and private equity to the future of investments in blockchain and generative AI. As we navigate the complexities of a fragmented world, Hong Kong has also been striving to move along with these trends to foster the growth of new and promising horizons. And we will continue to thrive on connecting with the rest of the world, proactively reaching out to both traditional and emerging new markets. This has given us valuable insights into the strategies we should embrace. Allow me to take a few minutes to share some thoughts with you. My first observation is that in the face of shifting global dynamics, we must stay agile, responsive, and innovative. With changing geopolitical landscape and a new administration in the US on the horizon, the market has been bracing for potential headwinds. But there is no reason to succumb to pessimism. As a matter of fact, countries and businesses are adapting and transforming. China, for example, has been undergoing remarkable economic transformation, marked by a shift towards high-quality development, growth supported by domestic consumption, technology innovation, green investments, advanced manufacturing, and many more. Chinese enterprises are also expanding their global industry and supply chain networks in response to shifting geopolitics. For Hong Kong, our strategy is to continue to engage with traditional markets like the US and Europe, while focusing on cooperation on areas of common interests and mutual benefits. Earlier this year, I had the opportunity to visit the US and Europe again, where I met with financial leaders, business and industry leaders, as well as entrepreneurs of different backgrounds. The key takeaways from the visits was straightforward. Notwithstanding the long shadow cast by geopolitics, there is still potential and ample room for cooperation across many areas, from urban planning to infrastructure investments to ESG standards and combating climate change. Taking green transition as an example, this is a process requires comprehensive transformation of our society and business activities, demanding long-term collaboration across industries, regions, and at various levels. Sectors such as aviation, shipping, transportation, and construction, along with businesses involved in trade and manufacturing, all need robust support in terms of policy, funding, technology, and talent. Given the complexity of the transformation process, we must seek innovative solutions tailored to address different challenges. By fostering cross-regional exchanges and engaging in cross-industry discussions at local level, we can uncover new opportunities for collaboration and identify promising areas of common interests for development. My second observation is that with shifting global economic gravity, the rising Belt and Road countries and the Global South at large presents boundless opportunities. The Global South now contributes to about 60% of global GDP in terms of purchasing power parity, and accounts for over 40% of global imports and exports. If we just look at ASEAN, it is collectively on track to become the fourth largest economy in the world by 2030. What characterizes these markets are rapid economic growth, young population, and an expanding middle class. And above all, they all share a strong aspiration for progress by pursuing investments in infrastructure, green transformation, and technologies. Amid challenging global landscape, they are also seeking to diversify their investments, sources of investments, and asset allocation. We are making significant strides to capitalize on the opportunities presented by the growth of these emerging markets. My recent visit to Saudi Arabia exemplifies this well. Joined by a delegation of over 100 members from the financial and innovation sectors, we return with rewarding outcomes, including successfully listing of 2 ETFs on the Saudi Tadawul, investing in the Hong Kong market, signing of investment and business cooperation agreements, and pitches by our Hong Kong startups. A significant insight from our endeavors in entering the Middle East market is the importance of a shared vision. For example, Saudi Arabia, undergoing economic and societal transformation, has underlined in its Vision 2030 the need for diversification, modernization, and greater openness of their economy. They are also actively embracing digitalization and green transformation. When looking for opportunities in overseas markets, their focus extends beyond simply investing capital for financial returns. They are committed to fostering reciprocal investments, sharing experience and best practices, aligning professional standards, and forging partnerships that will support their national development objectives. This visionary mindset fully resonates with ours. The strategic investments made by our investment arm, the Hong Kong Investment Corporation, as I mentioned in the speech yesterday, is clearly one example. What's more, it is our belief that there is the Hong Kong brand, comprising, among others, our world-class professional services, solutions by our tech sector, internationally aligned standards and practices can very much contribute to their growth and development. And we are doing just that. The fund that Saudi Arabia's PIF and the Hong Kong Monetary Authority will jointly set up is a testament to this shared vision. We will be investing together to help companies with a Hong Kong and Greater Bay Area leases expand into Saudi Arabia in targeted sectors, including manufacturing, renewables, fintech, and healthcare, driving their economic growth while reinforcing Hong Kong's position as one of the world's leading international financial centers, as well as a rising innovation and technology center. This is a win-win scenario. Ladies and gentlemen, despite the challenges posed by a fragmented world, I have no doubt that Hong Kong will continue to thrive, adapting to uncertainties and changes. Yes, and will be the new normal, to navigate in a landscape of change, adapting our strategies and harmonizing our vision with evolving aspirations of our economic partners is essential. But with all the unique advantages of our city, not least our internationalization and our commitment to innovation and progress, Hong Kong is set to remain an attractive partner for investors and businesses from around the world. Thank you.
Thank you very much, Financial Secretary, for outlining that vision and the opportunities for Hong Kong. Now, our first panel discussion will start very soon, and we would love for all of you to participate, and you can do this by asking questions. So on the back of your name badge, you'll find a QR code. If you scan the QR code, that will take you to a page where you can type in questions during any of our panels. So please, we'd love to have questions from the audience. Once you do that, those questions will go straight to our moderators, who can pose them to our panelists. So let's begin this morning with our first session, which is on investment outlook and long-term asset allocation strategies. As we know, the world is undergoing major transformation in so many areas, including investment. There are many, many factors at play. Both Paul and Julia had outlined some of them: changes in geopolitics, the emergence of new technologies, demand for decarbonization, emerging demographic changes, just to name a few. So against this macro backdrop, how do investors see shifts in opportunities across different geographic regions, asset classes, and sectors? Our first panel will share their tips on how they can lean into this kind of transformation while also maintaining a good balance of risks and returns. So I'd like to introduce our panel as they come up. We have our moderator, Ms. Christina Choi. Christina's Executive Director of Investment Products at the Securities and Futures Commission, and she's joined by Ye-Shin Hung, President and CEO of State Street Global Advisors, Laurent Ramsey, Managing Partner of Pictet, and Andrew Schlossberg, President and CEO of Invesco. So please welcome them all.
So good morning, and a very warm welcome to this first panel on investment outlook and long-term asset allocation strategies. So we have here distinguished leaders from 3 major asset and wealth managers from the US and Europe, managing multi-billions of assets under management among them, and they don't need any introduction. I'm sure you are all eagerly waiting to get some free investment advice from them. So I think just quick recap of what we heard yesterday from the summit. So we heard a lot about optimism about the U.S., the complexities in the macro backdrop and structural changes as a result of geopolitical tensions, the changes in race, and also the recent US presidential election. So for the US market, we heard the 40s, tariffs, taxes, less regulation and tightening of inflation, and a growth agenda. However, it may not be good news for the rest of the world. And I think, since the US election, many, economists have lowered the, forecast for other markets. However, on the other hand, the contrarians emphasizes more on these concerns about sustainability of the US deficit, the debt level, the inflation risk, and I think we heard Julia mention the unpredictability of the new administration in the US. And also whether the election proposals are more for negotiation than will. So, but on the trade side, we heard optimism about China +1 and the opportunities in Asia and the global South, and the supply chains redistribution and the new regional alliances being formed. So in this part of the world, China has been bracing for the challenges internally and those from outside, with more loosening fiscal policies, particularly since September, followed by the recent announced 10 trillion renminbi support for local governments. And we've seen the surge of liquidity and outperformance of the Hong Kong and China equity market. So, we are in very interesting and exciting times. So, this first set of questions is about your views on the economic and investment outlook for the, next 12 to, maybe 18 months and longer term. In terms of the major economies, the US and the rest of the world, and of course, China. So I will start with Yi-Sin. You are the biggest, one among the biggest passive managers. How do you see, the outlook for the US and other markets?
Thank you. It's a real pleasure and honor to be here with all of you. So one of the key themes we heard yesterday morning was about resilience. And I would say 2024 has been exactly that, as we saw gains across equity and fixed income markets, growth continuing to be fairly resilient at the same time that inflation has been abating. And that has led to central bankers around the world beginning to execute on interest rate cuts, maybe with the one exception of Japan. And so as we look forward to 2025, we see that path, that sort of path toward a soft landing continuing. And from a global growth standpoint, we remain optimistic, primarily for three key reasons. One is, of course, that central bankers largely in developed economies have begun to ease. Secondly, you mentioned China's stimulus. We expect even more stimulus to occur, so that's likely to reduce the downside risk and ensure the 5% growth rate that we're anticipating. And then lastly, when you look to the US, the strength of the consumer is quite evident. And it looks to be that not only is their savings rate not at 3%, but closer to 5%, that along with the strength of the technology sector, where we see earnings growth continuing. And despite the run-up in the equity markets, we still believe that there is upside opportunity. So on balance, we are overweight equities with a greater overweight to the US market on balance. If we go around the world, we would say that Europe, because of the strength of the household and excess savings, we think there's some upside there. In Japan, we view that as probably more of a sideways market, just as we look at what is the continued and sustainability path of growth and inflation. And then here across the emerging markets, we think there are good opportunities. I mean, I know we'll talk a little bit more about what might be the policies coming out of the US, but to the extent that they are more inflationary, there's likelihood over the medium term that we're going to see weakness on the US dollar front. So that should suggest strength in the emerging markets. And broadly, across fixed income, it's going to be a volatile ride as we understand the data and the path of inflation. On balance, we are more focused around sovereign debt, and that's on a global basis, probably closer to the medium and short end in terms of maturity. And so we also think here there's opportunities for emerging markets debt. And then on the equity side, I think very much will depend on the path of travel with tariffs, trade wars. What does that mean country by country, company by company? And then, as I said, I mentioned China before. Feel reasonably confident that at least in the near term, you know, the government's commitment to maintaining growth will continue.
Okay, thanks. So turning to Andrew, so what's your views and take?
Yeah, well, first of all, thank you to the HKMA for having us back again. It's wonderful to be here. Perhaps it's because I live in the United States, I share a lot of the optimism that Yixin shared already, but perhaps it's worth maybe contextualizing back to sitting on this stage, or a stage similar, this time last year as to how different things are. So if we were sitting here last year, we were talking about 65 to 70% of the world's population, democratic population, going to go through some election this past year. We were talking about China stimulus, waiting for it to come, and even recognition that we needed it. And we were talking about central banks and what would their policy be. And here we are today in a much different position, and Yixin already shared a lot of those changes. And we see it as a great opportunity for risk assets in the equity markets, in particular, a broadening out into small caps and mid caps, into emerging markets and things non-US, and in fixed income, moving out a little bit on the curve and being in municipal debt in the United States or bank loans throughout the world. And we can get into all of the risks that certainly persist out there, but I think we've got great optimism.
Okay, can I have a follow-up? You know, you have some views about, you know, Hong Kong, and how do you see, you know, the role of, we heard about Hong Kong can be serving, you know, the trade, the changes in the trade alliances, and also ODIs of China. It's a lot, you know, coming out and serving. So in the financial services or the outlook of Hong Kong?
Yeah, so needless to say, many of us are here. And so the outlook for Hong Kong is quite high. We run our Asia Pacific headquarters here out of Hong Kong and have for many, many years and will for many years to come. We also operate our domestic Chinese business right in Shenzhen. And so the now called, you know, Greater Bay Areas have been coming here, and our Shenzhen business and our China business and our Hong Kong business for over 20 years. It's prosperous. The resources are here, the talent is all here, the financial capital flow is very much alive and well. And I think the two-way bridge between you know, China and the rest of the world, but certainly this as an international center to connect all of us in the international investment community is really powerful. And as connected or unconnected as we may see ourselves in over the next several years, the capital markets will remain connected. And Hong Kong has always been a place where that happens.
Thanks for all the compliments of Hong Kong. But, you know, turning to Laurent, Europe. So, you know, we heard about the challenges, the war still going on, and, you know, in Ukraine and also Gaza, and, you know, the slower growth, but we have strong savings. So, and also, you know, I think Europe is going elections, and we've seen the Draghi report. So can you share a bit more to us about the outlook of Europe and what does it mean?
Yes, of course. First, let me again thank the HKMA, the SFC, and the Hong Kong Academy for Finance for inviting me. I feel humbled to be part of this panel and surrounded by giants of the asset management industry. When it comes to Europe, and obviously sitting at the center of Europe, the continent, even though we're not part of the EU, we have problems to be too optimistic, at least over the short to medium term. We see growth below potential at 0.7%. We see growth next year, real GDP growth at 1.2%. We see, as you said, savings going up, consumption stalling. So I think it's going to be difficult for us to be positive on Europe unless we see a very strong recovery in this part of the world and China, on which Europe is pretty dependent. But also unless we see Europe tackling the issue, which has been highlighted by the Draghi report, linked to competitiveness of Europe. If you look at the top 20 stocks, publicly listed stocks in the world, you don't see one European name, so that tells you something about the competitivity of the continent going down. I think the report highlights a couple of issues in Europe. One is linked to innovation, and not so much whether there is innovation or not, but the ability of Europe to scale up innovation in Europe. A lot of the good ideas are actually, emigrating themselves towards the United States for different reasons. The second issue is linked to the energy transition that needs to be tackled, and the impact it has on energy costs. The question of dependencies, you can think about defense, and obviously the question of access to a deep funding pool. Everything points towards a more integrated single market, whether you call it capital markets union or investment and savings union, like the new term including banking union. And the question is whether this is gonna happen or not. And the Draghi report recommends three things: reviewing EU governance, simplifying regulation, which is overly complex in Europe, and again, trying to deepen the savings pool, which, in Europe today, 80% happens through banks and bank loans. Now, I was in Brussels 3 weeks ago, and everybody agrees on the conclusion of the report, everybody agrees on the diagnostics, but when it comes into, turning intentions into action, member state interest still prevails. And unless there is a strong trigger to make them recognize that the greater good is perhaps more important than national interest, it's going to be difficult. So what can be the trigger? It can be perhaps a deepening of the war. It can be perhaps the US elections and Trump positioning on NATO and NATO funding or tariffs or some of those might be the trigger that we need for Europe to put its acts together. Now, there are glimpses of hope. So obviously, Southern Europe is faring better than Northern Europe, which is hard to believe, there's the revenge of the pigs, and not surprising coming from me, but Switzerland is a harbor of solidity and innovation. We think that from an asset allocation perspective, it's a high-quality defensive hedge. You can have high value-add sectors. You can think about materials, farmers, equipments, luxury, financial services. It has a strong currency, so from a US dollar investor perspective, is interesting. And it is very innovative. It became, again, the best country, according to the WIPO, in terms of innovation. 3% of the population have PhDs, 3.3% of GDPs in R&D. Yep. So that's a glimpse of hope for Europe.
Okay, good. There are still bright spots in Europe, right? Okay. So I think, Andrew, last year you were here, welcome back. And you said that we have too much cash on the sidelines. And are we seeing investors moving to riskier assets or markets? And how much risk appetite is there with the expectation of, the higher for longer? We still have quite high rates and global slowdown of economic growth and high levels of public debt and all the risks in the world. So we also see some, questions from the floor. Cash is still king, right? Or, are there alternatives? Yeah.
Yeah, no, thank you. Look at money market assets and cash assets are still at record highs and making new highs. So there's still plenty of cash on the sidelines. I think it started to move this year, and Yishin talked a little bit about it, and Laurent talked about it as well. As the rate picture started to change, I think now as some stability starts to come back to markets, as people's willingness to take on more risk assets, we have seen money start to be in motion. Those cash balances, though, are still quite high. I mean, I think I said last year, for most developed wealth managers, they report out, low 20% cash balances in people's portfolios, and maybe that now is in the high teens. But it's now a strategic asset with where rates are, and unless the rate picture materially changes, it'll still be a strategic asset. But I think there's plenty of opportunities that we, can talk about more of, and will talk more of. I think the one thing I'll add to the money in motion theme is that a lot of the stimulus, a lot of the policy changes, the retirement market changes that are going on in different places around the world that we can talk about, I think also create this change, generational change, or change in the way people are investing, or the catalyst and incentives to be in the capital markets is going to create more of a flywheel of money in motion where cash isn't going to be the preferred asset. It's going to be more in these risk assets. So still at record highs, sadly, to report, but I think there's a lot more visibility and opportunity to invest. And Laurent, I'll say, the valuations in Europe are quite cheap. So at some point, you only need a little catalyst for some growth.
Okay, so
Cheaper for longer.
Yeah.
Okay.
I said I'd play the optimist here.
Right. Good. Yeah, Yi-Sin, so what's your take? You mentioned about, sovereign maybe still good for the, the U.S. debt for short, medium term. So you concerned about, the sustainability of the U.S. Fiscal debt level?
Yeah, it's more of a concern, I think, for the medium term. The extent of debt in developed economies around the world is a theme. And, you look at the U.S. alone, I think servicing the debt is going to be pretty close to 20% of the annual budget and will likely only grow. And so what that suggests is that there's just less dry powder to encourage greater growth. And then you marry that with what we see as aging demographics around the world. I was mentioning to these folks, when you think forward just to 2030, and the baby boom generation in the U.S., they will all be 65 or older. And so this demand for income, fixed income, dividend yielding stocks, REITs, I think will continue to be a consistent theme. And we're just likely to be in a scenario where growth is just going to be lower. And so this argument of rates continuing to ease makes sense to find the right neutral rate. Our view, at least in the U.S., is that that's probably around 3.5, 3.75 by the end of 2025. And so as institutional investors start to think about where the opportunities are, we haven't necessarily seen all the productivity improvements, that we were hoping for. Obviously, technologies, whether it's renewable technologies, AI, quantum computing, all of these offer opportunities for some of that upside. And then thinking about secular trends, where those opportunities are. We are seeing lots of investments across infrastructure. We're talking about data centers quite a bit yesterday. All of that, I think, are areas, private credit's another one that has a lot of tailwinds. So really thinking about this spectrum of what kinds of investments can add alpha, and arguably private equity and venture historically has been in that camp. There's those that are diversifying in nature, and I would probably put infrastructure and real estate in that camp. And then lastly, those that can provide hedges. And so gold, for instance, is a really interesting asset class. We've seen that really run up pretty dramatically this year as sort of a hedge to geopolitical instability.
Yeah, so I think I have a question about gold. What do you think is the appropriate proportion for gold? Anyone?
Large gold fund.
Well, we do. I don't.
You're running the biggest gold ETF in the world.
Yeah. I mean, I think what we've seen across portfolios is probably in the low single digits in terms of exposure, but it does provide sort of that geopolitical hedge. It's a safe haven. It has diversifying qualities, and so. That's probably on balance where we see allocation.
Right. So Laurent, your advice on the bright spots or the asset allocation?
Yeah, I think quite a lot has been said. It's true that in following a brutal 2022, we've seen massive inflows in money markets and money market funds. We've fortunately been a beneficiary of that. But, you know, 2024 was filled with uncertainties on the geopolitical front, you know, whether inflation was going to be under control or not. So anyway, paid to wait. So basically, clients waited, were rewarded handsomely for that. Now, post U.S. election, we start to see a reallocation of that cash. I think, you know, with short-term rates coming down, the opportunity cost of staying in cash becomes more expensive. We see a steepening of the curve. We see correlation between bonds and equities, you know, being conducive to diversifying your portfolio. And we see an economic backdrop which is quite strong, with, you know, inflation under control and no risks of recession. So we've seen clients reallocating. We like, as we said, I'm not going to repeat what my colleagues just said, but we like the US, we like China, we like Southeast Asia, we like Switzerland. You got the point that we don't like so much Europe. We like banks, again, with a steeper yield curve and deregulation in the US. You know, it might be a beneficiary. We like utilities. That might be the new tech, given the massive investments we need to do in terms of infrastructure. We start to like some emerging markets on the debt side, especially those that are a bit less vulnerable to US tariffs, and names that have suffered lately: Turkey, Argentina. We like India. Golds, you know, like you said, we like having gold. I mean, it's not going to surprise you coming from a Swiss, but we like having some gold in portfolios as a diversifier. The thing we don't like is treasuries. You talked about U.S. debt sustainability. I think long term, it might be an issue. I think you said some of the figures that are quite staggering. You know, 123% of GDP, and with expenses that are going to have to go up. You know, when you think about you know, social security, income security, healthcare. You know, what is needed for the energy transition or defense. So we see that only going up in the U.S., and the cost of servicing that debt is massive. It's going to be bigger than the defense budget. So the key is going to be, you know, the ability of the U.S. to continue to finance its debts. I think out of the 35 trillion of debt, 20 trillion is funded by the public, and half of that by foreign investors. So the ability to continue to attract foreign money is going to be key. And for that, two things need to continue. One, the US needs to continue to be a hub for innovation, which I think it is. And two, it needs to continue to be perceived as a safe asset. And here again, you know, we're quite confident.
Can I ask you about you know, demands for renminbi assets or you know, bonds, you know, in view of the growing trades, you know, with the Southeast, you know, Asia and global South? Are you seeing, you know, how do you see the demands, or, you know, from clients or investors?
So we're long-term optimists on the renminbi. Actually, in 2014, we were one of the first, at least in Europe, manager to launch a renminbi bond fund. So that's 10 years ago. So that tells you a bit about our confidence. But the fact of the matter is that, you know, it hasn't happened yet. Demand is low. After an initial uptick, you know, we've seen allocation being reduced from our clients. I think renminbi is still 2% on forex reserves. So it hasn't picked up the way we would like to see it pick up, but we stay optimistic over the long term.
Sure. Any?
I mean, I'll comment maybe less on the renminbi, but just, you know, China in general. Within our domestic China business, which is a retail business, both on the equity and on the fixed income side, we have seen a pickup in flows over the last 6 months as stimulus has come in. Certainly not back to where it was over the last several years. So we see some evidence of green shoots in China domestically. The domestic consumer or the domestic investor is starting to show that. I think the foreign investor is looking for more. And I think stimulus continuing to be big and bold, and as that starts to work through the domestic economy and maybe some of the instability of the political relationships, foreign investors, I think, will grow interested, once again in China. But long term, the trends and themes haven't abated.
Okay, so maybe anything you want to add?
I would just say, when I think about fixed income investing, we have more and more investors now wanting to disaggregate the global ag. And so, in some cases, they are looking to invest more in China. Other cases, investors are looking to invest emerging markets ex-China, but it's also along every dimension. I think there is growing desire to be able to differentiate overweight, underweight, depending on the investor.
Okay. All right, so turning to the US equity market, I think, you all seems to be optimistic, but how about the valuation, the high valuation and concentration in the few, big names? And how can we diversify, or are there opportunities outside those 7 or few stocks? So who would like to start first?
I'm happy to start. I think if you look at the equity markets on a price-to-earnings growth ratio, it's about 1.5 times, which is below historic medians. And even with the tech sector, the Mag 7, it's 1.7. Our view is that actually the earnings growth of these companies is likely to continue. So I suppose we're more in the camp of, there's still interesting names to own. Now, obviously, with some of the themes around President Trump, focus on tariffs, immigration, deregulation, likelihood of inflation, I mean, you're starting to see the market respond accordingly. Andrew talked about growing interest and demand for small caps and mid caps, and we see that diversifying. In terms of opportunities, the deregulation themes are going to benefit the consumer stocks, definitely benefit financials and banks. Defense is likely to be an area that's going to see increased demand. And then particularly in the US, I think the energy companies, even this focus around fossil fuels, may pick up again. So those are some of the areas where we see opportunities. So much of this really depends come January. Exactly what are the policies and what is the implication and how much inflation do we see? The labor market, for instance, today is actually in decent balance. There's only about 500,000 jobs that separate openings and those that are looking for work. That's down significantly from the beginning of the pandemic, which was around 6 million. So even if there is some modest deportation, it probably doesn't add that much to the inflationary outlook. But I think this is a key thing. We expect the Fed to cut once again at the December meeting, but we have taken down what our expectations are for 2025. We were at 5, we're currently at 3. I think that's the key thing to really be focused on.
Okay, thanks. So, Andrew?
Yeah, I mean, the only, Yishin, I think, summarized it exceptionally well. There's 2 US markets. There's the largest 10 US stocks, which are 40% of the S&P 500, and there's everything else. And those kind of numbers we haven't seen, since the tech bubble into, the early 2000s, 99, 2000s. So Yishin's comment's right, though. I mean, they're there for a reason. I think the changes that are going on in policy, and then I just think the valuation differentials create an amazing set of opportunities that I think some investors, professional investors see. I think individual investors investing behind that need to broaden out. And Invesco is an active house, we're a passive house, we're privates, we're public, so there's not a bias that way. But I think active managers in particular, those that can go through the marketplace, public or private, and find these opportunities, they're going to be massive, and the valuation differentials are high. Just got to see some growth. And I think both can be true. I think the top 10 technology stocks can do well, and a broadening of the market can do well under these conditions.
Laurent, other, bright spots?
Yeah, as I said, we like banks. I think that the deregulation is going to be, and again, a steeper yield curve is going to be a positive for banks. As far as technology is concerned, if we look beyond, the big tech companies that obviously, benefit a lot, because with the advent of AI, you need to have lots of users, lots of data, lots of money to be able to, to develop those. There are some other sectors that might benefit. We like, as I said, some utilities linked to the need of electrification. Data centers are very power hungry. You need to produce that power. You need to invest in the grids and infrastructure. You need to cool that power. So I think that provides very interesting opportunities. I think three other sectors that are interesting, linked a bit to what's happening on the AI front. First is cybersecurity. I think that there's a new hack every 39 seconds. McKinsey estimates that in next year, cybercrime is going to cost $10 trillion per year. And cybersecurity solutions still have a relatively low penetration. So there is a massive market out there as companies are going to beef up their investments to be, to protect themselves. Cybercrime has the highest return on investment in terms of the time you need to spend and the risk you take in terms of being prosecuted and convicted. So a lot of people are taking that as a side job. So you need to protect yourself against that. The other sector that we like is robotics. I think Mike touched upon that yesterday. I think automation is going to be, is important in terms of also gaining productivity. This part of the world is the biggest producer of industrial robots, so it's there to benefit. I think China would need to increase its production, its usage of industrial robots by 2.5 times to reach the levels of automation of South Korea. So that gives you, an idea of the potential there is. So we like robotics. And the other part is some parts of health, diagnostics. For example, Biotech might also benefit.
Okay, thank you. So I think now turning to ESG investment, actually, this year we are seeing a bit of a drop in the ESG fund launches, and I think we noticed that ESG seems to be taking a more backstage in recent times, but we still know there's a huge demands for transition or investment, decarbonization. So how do you see the I think investor demands for and how to make investment for good investment? For investors. So I'll start with Laurent because Europe is notorious for its demands and keen interest in ESG investments.
Yeah, I think there has been some headwinds. You can think about policy or politics, a stalling COP process and commitments to the Paris agreements, stalling as well. You can think about regulation and you can think about performance. When it comes to policy or politics, I think there are stronger momentum that are driving a long-term growth into sustainability. I think that it makes sense economically, and again, I think it was touched upon yesterday. Today, solar and wind is the cheapest source of energy in most parts of the world. It provides less volatility than other fossil fuel sources of energy. It provides independence. So when you try to build resilience, it makes a lot of sense. And if you look at countries, look at China in 2023. They increased their solar production capacity by 217 gigawatts, which is more than the total U.S. solar production capacity. They invested $650 billion in energy transition in some shape or form, which is double the investment of Europe. So things are happening regardless of policy or politics. When it comes to regulation, and particularly in Europe, I think the debate has been hijacked by regulation and therefore compliance in our shops. When we launched our water fund in 24 years ago, we were talking about investment opportunity. Now people are talking about Article 8 or Article 9. It's very confusing for investors, and I think that is partly responsible why also there is, people are staying on the sideline because they don't understand. So I think we have a duty as an industry to be clearer in what we mean, and in going back to talking about the opportunity and not, and not all that jargon that people are using. For us, ESG is about risk, is about doing your job as an active manager, because I think that ignoring non-financial factors, physical risk or transition risk is actually failing your fiduciary duty. So everybody should do it, and hopefully soon we won't talk about it anymore. And when we talk about sustainability, again, try to focus on the opportunity. On the demand side, there was a Mercer survey on asset owners this year that says that 79% of asset owners globally will increase their allocation to climate strategies. Morningstar shows that in the last 5 years, investment in climate funds has increased tenfold. And in our interactions with clients, at least 2/3 of our interactions are related to sustainability. So even though there is short-term headwinds, we see the long-term potential as being, untouched.
So Andrew, you have observed some integration or more embedding of, ESG investments, or more on the practical level among investors?
Well, I think Laurent characterized it very well. And my only additional comment would be, if we could look forward, 10 years or so, that we're, well, the E and the S and the G are very different, and I think Laurent pointed those out. But I think we won't be talking about it in 10 to 15 years, not because it's not relevant, but because we're all in the business of allocating capital to companies for them to produce future cash flows and profits. And how things like energy transition, how things like consumer behavior, how products are created, it's going to feature. And so differentiating between the companies that can do that well and can't, I think, hopefully we're just not talking about acronyms in 10 or 15 years.
Good. So I think the last part of this, my questions, is about the rise of private assets, or the demographic changes and the need for longer term assets. And we have a lot of insurance company and also pension funds managers here. And so in a way, yesterday we also heard about the PE industry is undergoing structural changes, and the VC returns are dropping and not, like they earning what they used to have, and you have to be very selective in investments, and the investment skills and opportunities are less. And also, while we have the golden era of private credit, we also heard the tide has not gone out, and we haven't seen the naked yet. So there seems to be still quite a lot of, we haven't seen the real risk. And of course, we are seeing, a lot of investment needs and in transition and all this and infrastructure, etc. And the rise of evergreen or less liquid funds, long-term funds for investors. And also, I heard a criticism of the regulators' misconception about the risk of private assets. So do you think private assets are for everyone, or what do you think? What is role in terms of who would be suitable, for the investment portfolio? So as Yi-Hsin, you have been in the insurance industry as well, and now as the passive managers, how do you see the rise of the private assets?
Well, a big theme for us at SSGA has really been focused around democratizing investing. I think yesterday we heard an example of, you go back 10 or 20 years and you wanted to invest in the market, you paid a big commission. And today, obviously, commission-free platforms are available. And when I think about the advent of the ETF industry, you can have $100 and get exposure to any number of stocks. And so I think when you step back from the conversation around, when will we see sort of differentiation across managers? I mean, this business has always been about skill, right? So I think that is fundamental. But at the same time, the number of public companies have declined dramatically. And, with the regulatory environment for banks globally have been pulling back in terms of extending credit. And so these are all areas where there is value creation happening. And so one could argue that institutions have had access to all of these asset classes for a long time, and we've seen allocations grow dramatically. Some of the largest institutions are potentially even north of 50% of their portfolio allocated. But when you look at individual portfolios, they're less than 10%. Now, I think it is important to take into consideration transparency, valuation, liquidity. All of these, I think, are important to take into account because individuals, through home ownership or through retirement savings, those can be more illiquid. And so to suggest that individuals should have the same allocation to alternatives as institutions, I'm not sure that's correct, but I do think there is room for more.
So Andrew?
Yeah, sure. Echo Yishin. Maybe I'd add, as retirement markets become increasingly self-directed, defined contribution plans, whether that's in the US, what's happening in Japan, even over time what will happen more and more in China, privates we need to help find a way for them to play a role, just like they do in a defined benefit scheme with institutions allocating significant amounts of their capital. I agree with the comments made yesterday too, that the blurring between public and private investment is going to take hold or can take hold. But the notion that I think one of the ways for the public markets to get re-stimulated is to make it more favorable for companies to enter the public market, whether that's regulation or whether that's just capital that's harder and scarcer to find from private sources maybe over time. And for banks are certainly going to play a role. This isn't all moving to private credit. Public credit and private credit are going to coexist. So in terms of democratizing it and bringing it to individual investors, I think Yishin covered it well. The only thing I'd add is that there is quite a steep learning curve, and education is going to have to sit really close to good investment capabilities. And I think we all have good investment capabilities. It's how do you create the education to prepare for illiquid moments, which will come.
Yeah, Laurent, so you are, a well-known manager or advisor to the private world and private banks. How do you, are the private assets for everyone, or how do you advise the individuals to make the investment choices and monitor, the risks?
Yeah, first on the growth of private assets, we think that by 2030 is going to be 20% of global assets, 45% of global revenues of the asset management industry. 80% of that will still be institutional money, mainly pension plans and sovereign wealth funds. But the private money invested is going to grow by 15% per annum, reaching 5 trillion. I think demographics is helping. I think, as Yishin said, there is a wall of wealth transmission which is starting and which will continue for the next 20 years with, I think, 90 trillion of baby boomers' wealth, which is going to go to the next generation. And as it goes into the next generations, obviously, the next generation has a longer longevity and therefore has the time horizon needed to invest more in private assets. And also something that people overlook often is that some part of that wealth transmission is actually done to philanthropic foundations. And those philanthropic foundations, by nature, have long duration when they deploy their capital. So that's another, I think, element that will increase the propensity of clients to invest in private assets. Now, when it comes to private individuals, we still see 90% of that savings pool coming from ultra-high net worth individuals and family offices. So when we talk about democratizing private assets, I think we still need to remember that this is what it's going to mainly address. And when we talk about retail investors, I think we need to be careful. I think that democratizing access through adequate wrappers for long-term investment is something. But the two risks I see is, one, a risk of suitability, because to invest in private assets, you need to make sure you invest your nest egg, your reserve assets that you don't need, because even with semi-liquids, there are some risks. There is an illusion of liquidity that we have to be very careful about, and this is where transparency comes. Those semi-liquids, still give you a cap of 3 to 5% redemption on assets per quarter. So if a crisis hits, you're going to be gated. And this liquidity is provided, has to be provided somehow, because you can't make something illiquid liquid. So it's either through, subscriptions, either through income distribution or through borrowing. So it has, or through putting liquids in a semi-liquid portfolio, which dilutes private asset returns. So I think, I don't think it's for everyone, but I think it's going to be a growing part of individuals' investments.
Okay, thank you. So I think, just last call for any questions for this panel. I think, I think we cover, most, but there is a question on crypto. Your views on crypto and the new administration, really, deregulation. Are you investing any crypto in your portfolio? Or what do you see? Are you planning to? Anyone?
I think for us, our focus has been on sort of the broader digital environment, not necessarily the cryptocurrencies themselves. I mean, there are a number of different companies that are ways to play what we think will be a growing area. And it's very clear, I think, with the new administration, this is going to get tremendous focus, probably a top priority of our primary regulator, the SEC. But blockchain, I think we talked about yesterday, tokenization. There's a lot of opportunities in this space. And I would say as investors are really thinking about, we've talked about the short term, the medium term, longer term, it's really about these new technologies. And you asked originally about China. China is very advanced in terms of renewable technologies, advanced materials, quantum, digital, AI. These are all areas that I think are quite interesting as we look out to the future.
Okay, thank you. Lauren?
Yeah, when it comes to the underlying technology, we're quite involved, and Switzerland is quite advanced actually in providing the infrastructure necessary. But to answer your question in terms of crypto and Bitcoin, do we advise clients to buy them? No, we don't. We let them do it. I think we try to give advice on things that we understand, and we can't understand everything. And so yeah, no, we don't provide advice.
You let them do it. Okay. Andrew.
I'll let them leave it at that.
Okay, I think we just have 1 minute, but I think, thanks very much. But, the one last piece of advice or the most important investment, if you want to choose for the next, 2025, can you give us just one short answer from each of you? Andrew?
I just keep the long term in mind, try to avoid the noise, and think about the next decade, not the next 12 months.
Thank you. Lauren?
I think I would try to widen my exposure to the wider tech that can benefit from the very rapid developments on AI, as we discussed.
Thank you.
I agree wholeheartedly with my panelists, and I would just say diversification broadly, thinking about what parts of your portfolio are addressing different environments that we might find ourselves in.
Yes, thank you. So please give a big hand to this panelists. Well, thank you.
Christina and our panelists, could you stay on stage and come to the front for a group photo, please, before you leave? Thank you. And everybody will be adding gold bars to their Christmas wish list. Crypto if you want. Ladies and gentlemen, could you also smile for the cameras at the back of the room to the left of the video cameras? Those are our media photographers who are here. Fantastic. Thank you so much again, Christina, Isin, Andrew, and Laurent. So our next panel will be looking at alternative investments, which of course are taking on a bigger role in today's investment world. We have a great panel. Our guests will not only share the focus of their own firms, but also the global alternative investment outlook with a particular focus on risks and opportunities in Asia. The discussion will be led by Ms. Harshika Patel, CEO at the Asia Private Bank of JP Morgan, and our panelists are Juan Delgado Morero, co-CEO Hamilton Lane, Goodwin Gore, Chairman and Managing Principal of Gore Capital Partners, Deborah K. Orita, President and CEO, Public Sector Pension Investment Board, and Jeffrey Pearlman, CEO of Warburg Pincus. So please give them all a warm welcome as they come to the stage.
Okay, well, good morning, everyone, on this gloomy day. I'm Harshika Patel, delighted to be here. My job as moderator is extremely easy because, firstly, I'm with a highly opinionated bunch, and secondly, I'm told that they are the A-team of the alternatives world. So therefore, I'm sure they can talk amongst themselves, and I can simply just take notes. In all seriousness, the whole alt space, as you've all heard yesterday in today's earlier session, it's an area which has enjoyed explosive growth, and in fact, if you look at the next 3 to 4 years, an area that's expected to double in terms of assets under management. Now, as I was walking over here today, I did think to myself, it's a gloomy day, number one. Number two, it's a panel about alternatives. So how do I introduce these wise, panelists of mine in an alternative way? So do humor me, because I consulted my best friend ChatGPT, applied a bit of prompt engineering, and this is what we got, okay?
Totally unscripted.
Here we go. Yes, I didn't tell them about this, by the way. So, in the heart of Hong Kong's financial domain, where investment prowess really does reign, 4 veterans gather, collectively managing 440 billion USD, surpassing Hong Kong's GDP. Jeff Pearlman, the visionary, with a mind so keen, Juan Delgado, with strategic precision that never goes unseen, Goodwin Gore, the master of deals and sway, Deborah Orita, guiding where diversification leads the way. Their journeys in Asia and beyond, a tale to be told. In the world of finance, their stories unfold. At the Banker Forum, where insights will shine, guiding us through the evolving investment line. There you go. Thank you, ChatGPT.
Fantastic.
Okay, so with that, now we get down to serious business, Juan. And since you're sitting directly to my left, I thought I'd start with you. Firstly, a huge congratulations. So Juan now is the co-CEO of a global company, Hamilton Lane. You're doing it here from Hong Kong, so I'm sure your hours are just as pleasant as mine. Hamilton Lane has been in this space advising, clients on the whole alternative space for almost 40 years. Yesterday, in an earlier panel, we'd heard about the explosion. We hear about private credit, real estate, infrastructure. So alternatives captures so many sub-asset classes. Do you mind, for the broad audience in the room today, just helping us unpack that and why we are where we are today?
Sure. Thank you. I have to say, it's the first time I feel totally upstaged by the moderator.
I'll take that as a compliment, Juan.
Absolutely, as well you should. So, so we did script this piece that comes now. Well, I think you heard yesterday in the panel that we should abandon the word alternatives, and I think that's really, really relevant for a number of portfolio considerations. But just to really paint the picture, we are not really the lion that has been described. We're more like a little cat in a corner. So, for example, last year as an industry, actually this year, annualized, we'll raise, so fundraising will be about $1 trillion. That's not even 2% of the market cap of the S&P 500. And that's not a horrible year. That will be a top 10 year in the history of the asset class. And no, that's not just PE. That's PE, venture capital, real assets, credit, all of it. And no, I'm not wrong. So it's not as big as you think. There's many ways to skin the cat. Oh, Juan, you mentioned fundraising, that's down. How about NAV? We all read the report that there's trillions of dollars out there that can never be sold, and so gotcha now. Let's take the high number, around $9 trillion. Again, everyone likes to talk about the buyout side. It must be the biggest. It's not. Buyouts are less than 45% of that. So again, it's not what I say or what Mark Rowan said yesterday. The asset class is really widened over the last few years. What is the other half, Juan? Nearly equally split between venture, again, real assets, and credit. Everyone loves to talk about the credit guy swimming naked. No, nobody talks about the VC guy swimming naked, even though most of the times they are the ones swimming naked. The point I want to make is the largest growth of that $9 trillion, the largest part that has grown most dramatically over the last 5 years is venture and growth. You have nearly $1.9 trillion. So whenever you read some of those reports about the aging of recent investment in alternatives, that's the pig in the python. It's not credit, although it's very relevant, or perhaps more directly relevant. Nobody comes across nicely as criticizing the venture industry, which is not my intention at all. But that's just some big numbers. Last one I'll give you of my scripted remarks. I can't recite a poem like Hachika, but we'll try later. But the other element is liquidity. Again, lots said about liquidity has been very down this year, although it has improved. And I'm not going to make any remark about the future until I get asked the question in a minute. But I think that people forget that the record year of 2021, the volume of liquidity in private markets, again, real estate, private credit, venture, was $1.6 trillion. So we have, as an industry, in 1 year, nearly liquidated a dollar amount equivalent to nearly the entire book today of net asset value in buyouts. So all we have to do, quote unquote, all we have to do is easy for me to say, is just get back slowly to levels of absolute dollar liquidity we have seen. So I'll stop here.
So can I just ask a quick follow-up question? So alternatives equals private equity, venture, infra, real estate. What about hedge funds?
Hedge funds, in many respects, are not counted on the statistics,
right,
and they are seen as much more liquid. I like the way it was approached yesterday, which I think is the one that sticks. And in the panel this morning is liquidity versus illiquidity, right? And it's a continuum, it's not a discrete, bright line. And up to this point, hedge funds have operated in structures that are on the more liquid side of that. Now that continuum is getting breached from the illiquid side, but more and more liquid structures. So I think over time, we'll have a much closer relationship between the two. But in terms of the allocation of role that I described in the statistics, hedge funds have been on the liquid side of that consideration.
Right. Okay, thank you. So Jeff, another congratulations in store for you. Recently appointed CEO of Warburg Pincus, the oldest private equity firm out there, I believe 1966. So just following up from the question I asked Juan, he referred to private equity. I think one of the panelists yesterday talked about the number of people employed in the private equity industry, talked about the number of companies who are, which are private in the US versus public. And there was one quote that I thought was actually quite relevant, which I wanted to zone in on this question. It's not hard to make investments, but to do it consistently is very hard. And you guys have been doing it consistently. So how do you make wise investment choices in the PE space consistently? That's point one. Second question, clearly there's been ups and downs in the PE world. I think, once again, the phrase used yesterday was the industry was declared dead on many occasions. late 80s, 2000, and then more recently. Is it P's time to come back?
I probably should have brought a pen and paper to write down those questions, so you'll have to refresh me if I get it wrong. First, obviously, thanks to Eddie and the HKMA team for having us. Look, I would say on how we think about investing and having the longest kind of continuous track record of investing in the industry, I think for us it's always been about a core principle of diversification. You heard it on the panel right before this. I think our ability, as we've had many panels over the last kind of day and a half, there's a lot of uncertainty out there. And it's very hard to predict the future. And I think because of that, I think the core principle of diversification, I think, really gives us a lot of protection. And I think one of the areas where you've seen the industry kind of lose an element that it's had over time is persistence, right? Persistence is very much faded in the industry, and part of that is everyone just focused on the US, or just focused on tech in the US, or just focused on venture tech in the US. And as a result, the liquidity element has been very challenging, right? You haven't been able to sell much in your portfolios. The industry has basically delivered 50% of its historical average in liquidity in 22 and 23, and probably 24 is not going to be far off from that. I think the ability to be diversified has allowed us to continue to find things to sell in the portfolio that are uncorrelated over time. So I think that's one huge benefit of it. I think the second is really a dynamic allocation model of investing, right? Things change. Sector diversification, geographic diversification. I'd say coming out of COVID, we've probably been more mature market centric, right? Given the repricing that's gone on in a number of these markets. And also they're the deepest, most liquid markets for exit. So we've really prioritized those, and I'd say probably our 14th flagship fund right now is probably more mature market centric than it's been in the previous few funds. At the same time, from a sector perspective, you always have episodic changes in the market. Take financial services. Obviously, coming out of Silicon Valley Bank a year or so ago, that was a great opportunity for us to step in. And one of the areas we love about financial services is it's like the least competitive area of private equity, right? 20% of the economy is in financial services, but yet it's 2% of the dollars raised in private equity. So for us, it's really twofold. It's the importance of diversification, but also having a dynamic allocation model that you're not forced to kind of just deploy capital if you're not really that comfortable from a risk-reward perspective.
And yesterday, Jeff, we heard about also finding the right talent and capabilities. In this world's highly competitive place, how do you ensure that you attract them and keep them?
Yeah, look, it's an excellent question. I always say we're in the human capital business, and when I think about our firm and the differentiation, one question I routinely get is, do you want to be public? And my answer is always the same, which is if I ever felt like we'd be at a competitive disadvantage, of course I would feel the need as a leader to look at that closely. I'd say at the minute the opposite is true. I think it's really been a competitive advantage for us to continue to be an investor-first private partnership. Both because I think this perfectly aligned triangle that's worked for us for nearly 60 years, when our portfolio companies do well, our LPs do well, and we do well in the process. And I think it's really important to continue to maintain that. I think the second is on the investing talent. Investing talent wants to be in an investor-first firm, right? They want to find the needles in the haystack as opposed to maybe just buying the market. And I think that's been a huge attraction for us. And also our aligned ownership model. Everyone eats from the same pie, and I think that encourages great collaboration and a willingness for people to want to stay and invest their career at Warburg Pincus.
Fabulous, thanks, Jeff. Okay, so from switching from providers of alternative solutions to Deborah, an allocator. You've been in the whole, Canadian pension fund industry for a very, very long time. And apart from US endowments, actually, the Canadian pension fund industry has been a big allocator to the alt space for quite some time. Actually, if I look at the averages, it's almost like 30% of portfolio allocations to alternatives versus pension funds in this part of the world, which are high single digits, if that. So how did you guys start that journey so early?
So, and I would actually say that because we started early, in a lot of areas, we're not just an allocator, we're a direct investor. So for example, we've been doing infrastructure investing directly for almost 20 years. We've been in private credit since, PSP has been in private credit since 2015. And those direct capabilities coupled with in areas like private equity, picking great partners, has allowed us to deliver good returns that support the pensions that we fund. So PSP 25 years ago was 5 billion Canadian dollars, and now we're 270 billion Canadian dollars. Over half of that is in private markets. So 10 to 15% in private equity, 30% in real assets, which is infrastructure, real estate, and what we call natural resources, which is about 70% agriculture, and 10% in private credit. And those alternative asset classes give us not only diversification, as ChatGPT has pointed out, but...
No, that was my prompt engineering, by the way.
But also deliver to us factor exposure that is valuable to back the liabilities that we're looking to fund, the pension liabilities, right? So for example, from infrastructure, we get not only inflation protection, but also stability. And natural resources we get, or agriculture, we get diversification that really adds to the stability of the fund overall, which is important for us as a pension investor. So I think that, how did it start? It's really about asking ourselves, what liabilities are we funding? How do we best build the best portfolio to fund those liabilities, and I guess the early mover advantage that the Canadian pension funds had in building some of these capabilities.
How did you get your trustees comfortable almost with that first mover advantage? I mean, Juan talked about some of the risks, perceived risks in this asset class. We heard about it yesterday as well. So how did you convince everyone that this was the right thing for a pension industry, which is typically looking for safe returns as well?
Yeah, I will say, I joined the industry about 15 years ago, and at that time we already had an approach of diversifying into alternatives. So I wasn't around when the original convincing had to happen, but I will say now that the returns speak for themselves. The stability of the returns that we've delivered, the benefits of diversification to our portfolios, and the opportunity that we give our beneficiaries and contributors to get the benefit of partner and investment selection, of the opportunity to do value creation, which adds value over what's available in the public markets, and given the long-term nature of our liabilities, the opportunity to harvest the illiquidity premium.
Great, thank you. Thanks, Deborah. So Goodwin, moving to the sexy industry that is real estate. John Gray talked about falling in love with real estate all over again. It's been a sector that your family has been in love with for a very, very long time. You fell in love with it personally in the mid-1990s. How has real estate investing evolved since the mid-1990s to today? And how do you approach this sector differently when you think about the decision-making back then to today?
Well, it's quite different, right? So obviously, Chinese love real estate. If you go across Asia, you go across any city or any country that actually where the businesses are dominated by Chinese, we tend to believe bricks is a better storage of value than actually cash in banks, right? So historically, that's the context. But obviously, things have changed because the way we live, the digital world we live, which as a result, the way we consume real estate is very different. And because the way we consume real estate is different, we have to think about how the real estate of tomorrow will weather the storm relative to how our lifestyle is changing. And from that point of view, I think one of the questions you were going to ask me is, how do we think of how to allocate investment into real estate today? And I would say, I think of it in 3 themes, right? One theme is distress, one theme is actually growth, and one theme is geopolitics, which leads to China plus one. On distress side, it's relatively easy to figure out because US in particular has a system to reset itself very, very quickly. As a result, value do drop very rapidly, and they tend to then pivot and rise very, very rapidly. In fact, many of our banking friends here, the new guy always want to write off everything the old guy did because then he gets a much easier way to write back the write-offs to get his bonuses, right? So because of that, you actually are able to get some interesting reset. And case in point, the one area I like the most is what everyone hates office and everyone hates San Francisco. I said that's actually what I want to go back in, purely because everything is about data center, AI, power, everything is about AI. And where's the global hub of AI innovation? It is San Francisco. Stanford, Berkeley, UCSF, you name it, all the talent is there. And then also these AI companies these days need to be collaborating with each other rather than being a closed garden ecosystem of Silicon Valley. That's one. Secondly, and then on distress, right, we have been doing quite a bit in Hong Kong on the credit space, but more because we're trying to fill the space where the big banks want to get out of. They want to reduce exposure to real estate. They want to reduce exposure to a lot of the high net worth Chinese developers, real estate in Hong Kong. And Hong Kong being a very robust and easy place to actually enforce your rights has been a very good area for us to participate. And then secondly, I was thinking China plus one. That's a relatively easy one, right? While you think that geopolitics is putting a lot of pressure and stress on Hong Kong, at the same time, it's creating a lot of opportunities in ASEAN. As Victor said yesterday, all the linkage is now, instead of one-to-one China to US, manufacturing floor to the consumer, it's actually multiple. So we have been very focused on ASEAN. And as I looked around the world, China plus one means Mexico is going to do very, very well. So we're buying warehouses on the Mexico-Texas border because there are so many Chinese factories opening new factories in Monterrey, Mexico. And then obviously Vietnam is a very big beneficiary in Southeast Asia in particular. And then lastly, on the growth side, right? Other than data center that everyone talked about, we don't have to repeat it. I think you see there's a reason why Bernard Arnault at LVMH has been investing heavily in travel, luxury travel in particular. As we mentioned earlier, Laurent mentioned earlier how much money is in the high net worth space. Experiential travel is becoming a new luxury. And that's why Oriental Express is launching trains. All these luxury new cruises are being launched. So experiential travel is becoming a new luxury, and that's going to be a sector that you can actually have a lot of growth in Southeast Asia and also in Southern Europe just because of cheaper labor, authentic experiences, and high margins.
So Goodwin, I hope I get mates rates when I stay at one of your hotels anytime in the future.
Please visit the region. Best view in Hong Kong.
You're not supposed to be plugging your business, Goodwin. That's my job. Anyway, swiftly moving on.
It's always a tough act to follow.
Oh, they're good, aren't they? I told you they're opinionated. Okay, looking forwards, Juan, I think the previous panel slightly touched on this, which is the evolving investor community in the whole alternative space. I mentioned it in Deborah's question. Endowments, US endowments were first, the US pension funds, and certainly US led the way. And now we can see it coming to Asia, and including a broader range of allocators, insurance companies, high net worth. Can you talk about, firstly, how that journey has evolved? And then number two, as you solve for some of the themes like liquidity, and particularly like high net worth needing liquidity, how your product suite has evolved accordingly, for example, Evergreens.
And do all of that without selling my own products.
Precisely.
I would
say nice things about JP Morgan
yes,
Private Bank.
And we have 5 minutes we need to get through. I will just caveat slightly the lead in that in Asia, all of the above has already happened. Perhaps with the exception, I'll come to the Evergreen, but obviously appreciating our distinguished hosts. We've had institutions, leading institutions in Asia invested in private markets for 16, 17 years. It's nothing new, and it's not unique to the leading institutions in Hong Kong and in the region. It's been mentioned as well, the shift to defined contribution, again, something that has played out sufficiently in the world. The leading DC markets are long established and invested in alternatives in private markets, Australia, Canada, Israel, Chile. So it's very, very widespread. The whole discussion about target date funds and 401k is a very US-specific conversation, but we shouldn't take that to mean that we're still expecting to catch up conceptually. In the UK is going through its own process of introducing private markets in DC through a procurement process, but that's more to do with the structure and the cost and the procurement in the market than with the ability of private markets to perform in those contexts. So, so that said, it is relatively recent to have semi-liquid structure, so-called evergreen or open-ended. And the main reason, as I like what has been said in the panel, is returns. Returns is why we're here. We're overall experiencing this growth because the asset class has delivered returns. And of course, in the last few months, with the S&P 500 having this amazing run and the Trump bump and all of those things, it doesn't seem necessary, but people very quickly forget the experience of the last 3-4 years. So because of returns, we're dealing with this arrival of the high net worth. And we have just copied, to your question earlier, the industry just copied the hedge fund model here. The structures are very similar to the subscription models of hedge funds. And by the way, they were not invented yesterday. One of the other funny paradoxes is that there have been funds with these structures for 15 plus years. They just become popular. So I'll leave, conscious of time, with my final remark is, I think rather than the industry appearing or being reported to be pushing product into a different constituents, also sometimes making us practitioners feel like we don't like our institutions. We love institutional investors. That's all we do since 1991. But the point is the industry is responding to a demand by institutions such as your own and many others to deliver the same level of returns in a format that is slightly more liquid. And again, conscious of time, I'd say the jury is out there, you could say, because of the absence of a major crisis. But so far, it's pretty successful. Again, we've operated our own. We are one of the top 5. We run over $9 billion. We started in 2019. I don't need to remind this audience what has happened since 2019 to today. I wouldn't call that a smooth ride. And so we've had a monthly NAV and monthly liquidity for the last 5 years.
Great, thank you. Jeff, a country that we didn't talk about too much yesterday or in the earlier panel, but too big to ignore. I'm from there originally, India. You guys have done a phenomenal job in India. It's not an easy country to navigate from an investment point of view. 1 minute on how you've done it and why you're so excited about it.
Look, India, to your point, is certainly been the big topic of conversation for many investors. We've been there nearly 30 years. And I think one of the keys to success, and this is really true across Asia, is really being local. You have to be kind of local, both in the entrepreneur community, the ecosystem, who to invest with, when to invest, and more importantly, also when to look to take liquidity. And one of the great things about India right now is that investment flywheel is working as well as almost anywhere in the world, maybe on par with the US. The IPO market's probably the best in the world right now. Continued strength in public markets attracts more investors to want to deploy more capital, and then obviously allows other strategics to want to step in front of some of those companies looking to go public. So the flywheel's worked incredibly well. We've used that to actually also monetize a bunch of our positions through the public markets, but continue to find really compelling, attractive opportunities to continue to deploy capital. And I think as capital has been diverted across the region, India, no doubt, has kind of been a beneficiary of it.
Okay, thank you so much, Jeff. Deborah, it's a big question, but 1 minute to answer it. Obviously, geopolitics, macro challenges, monetary policy, quite challenging. Once again, as an allocator of capital, how do you think about all of these factors on how you think about allocating capital?
I think actually the complexity of the investing environment makes diversification even more important. I think that our diversification across public and private markets, across geographies, is really important, and even within the alternatives, the diversification across the asset classes, because private credit behaves differently than infrastructure, than our agriculture assets, for example, and that diversification is really important in an uncertain world. I think the other thing for us is really focusing our own active management and direct capabilities where we have long-term conviction and developed expertise. So in areas like infrastructure, where we've been in it for decades, in areas like private credit, where we've been there for almost 10 years, really focusing on those areas and thinking about where there might be opportunities to leverage that expertise. So for example, infrastructure debt is a combination of the credit expertise where we have a long history and the infrastructure expertise where we have a long history, and looking at the infrastructure opportunities across the capital structure and being able to make that decision about where the best relative value is an opportunity that we think is important, and important when capital rushes into certain asset classes and you want to be able to have other ways to leverage your expertise.
Great, thank you. So Goodwin, it's a gloomy day. I started with a poem to lighten the mood. We're in Hong Kong. Can you talk a little bit about People's Place?
People's Place, it's actually a collection of 27 shopping centers that caters to the middle to lower middle class of Hong Kong. It's a bit unique to Hong Kong. These are assets that actually, shopping centers that sits below these housing estates that are catered to subsidized housing projects. So this is a portfolio of assets we put together, obviously catered to the masses. And what we did, as I go back, real estate is still product, right? Real estate 101 is still about product. So when we looked at that product, when we bought the portfolio, we looked at it, we said, how do we actually use this product to make the life of the people who live in those places better? If we achieve that, the rent and the cash flow will take care of itself. So the one thing we did, many of these malls have a rooftop sports court, but they were dilapidated over the years. So all these 22, 24 towers look down on these rooftop sports court, dilapidated. So what we did was actually we brought in creative Hong Kong designer, grew up in this housing estate, and actually fixed 3 or 4 of them to start, to actually create some, we say, how do we create hope through sports? So the first step is how do we get some love or show some love? When we did that, we actually brought a lot of kids to play in the playground. The grandmothers were able to actually hang out in the shopping center and eat the food. And then we had restaurants to actually come up with awards for kids who get good grades in those public schools. We started by doing that, and then we got corporates to actually help us fix those courts after we fixed 3 or 4. And then we actually we team up with the NGO to start a basketball league for kids 14 and under. Started with boys team and then girls team. And we started with 7 of our teams to allow these estates to have teams to play against each other on these beautified courts to create a league. And that league is now 28 strong on women's and boys. And many of these malls are no longer ours. Some of these are actually our competitors saying they're going to fix up the court and join the league. And I think we did achieve that. So it's back to Real Estate 101. And as a result, also, you don't read in the newspaper about the rents going up in these centers, because the increased footfall, increased revenue actually more than make up for the increased rent.
Absolutely love it. Uplifting communities. Thank you, Goodwin. So before I let you go, we're coming up to 2025. So I'm not going to ask you where you'd invest $100,000 because everyone's been asked that question. Right, quickly, your New Year's resolution, investing New Year's resolution.
No, I will invest it in my Evergreen global private assets. I mean, that's...
That's your New Year's resolution?
That's a New Year's.
Okay, perfect. Goodwin?
You're negative 4 minutes.
I know, but moderator's privilege.
Well, in a higher for longer interest rate environment, likely inflationary policy from the new president-elect, you actually have to go back to Real Estate 101 and find buffers, how to create value through fundamental in real estate investing again.
God, they're all talking their own book. Deborah?
I will talk my own book. I think that my New Year's resolution would be to invest with focus and foresight, to leverage our structural advantages, and to make sure that we're working with great partners.
Great. Final word, Jeff.
Focus on pricing power. I think to Goodwin's point, worried about inflation, you've got to be able to kind of find businesses that can pass through that incremental cost to customers and protect margin. So for us, very focused on pricing power for businesses.
Great, thank you so much. Ladies and gentlemen, a huge round of applause for our wise panelists.
And thank you very much, Harshika, for moderating that panel. Can I ask you to go to the front and gather in the middle for a group photo? Just come a bit closer together and forward a bit more. Thank you. Excellent, and stay there for the media photographers who are at the back on the left. Another big smile for them, please. Wonderful. Thank you again, Harshika, Juan, Goodwin, Deborah, and Jeffrey. So in our next session, we're going to continue the theme a little bit, and we have three very seasoned private equity investors who are going to share with us their take on the current state of private equity markets in Asia, the trends and opportunities in individual markets, and also investment in technology in Asia. Our moderator for this panel is Mr. Samson Wong, Chief Investment Officer, Private Markets at Hong Kong Monetary Authority. He's going to lead the discussion, joined by Nisa Leung, Managing Partner, Chiming Venture Partners, Jean-Eric Salata, Chairman of EQT Asia, EQT Group, and Zhang Lei, Founder and Chairman of Hill House. Our stage is reset, so we can welcome our moderator and panelists to the stage, please.
All right. Good morning, everyone. Today we're going to have I hope, pretty interesting discussions. Yesterday in the summit, we have a panel focusing on the trends of global private equity. And just now we have a panel talking about alternative assets. So now for this particular panel, we're going to zoom in more specifically on private equity in Asia. May I remind the audience that you can scan your QR code, and then towards the end, I'm going to ask our panelists the questions that you're going to raise. So without further ado, let's begin. So Sean and Lei, in the recent years, we have witnessed a confluence of factors: higher rates, escalating geopolitical tensions, and a slow exit environment for private equity, including Asia. All these factors are leading to some sort of risk aversions among investors, limited partners specifically. And notably in Asia, private equity fundraising has slowed down a lot from the peak that we have seen in 2021. So can you share with us what you're hearing from your large institutional investors around the world, how they think about asset allocation? Are they still interested in Asia? And are they approaching Asia differently? So maybe I'll start with you, Sean, first.
Well, thank you, Samson. Thank you to HKMA for hosting this event. It's great to be here. I think the question I often hear from investors is, we've been making so much money in our private equity programs in the United States. Why even bother come to Asia? And I think that, if you look at the last 10, 15 years in private equity globally, returns, you could argue, have predominantly been driven by two things, largely been driven by two things. One is declining rates, which have essentially resulted in expanding market multiples. And the S&P 500 has been a great place to invest, and that kind of market beta has driven and lifted all boats, including private equity. The second key driver of returns during the last 10, 15 years was very low cost leverage, almost zero interest rates for a period of time. And that
enabled people in developed markets to use cheap debt, expanding multiples, rising stock market, and of course there was also a lot of good things happening in the companies. But the effect of that was to, I think, create a kind of very high levels of returns in developed markets, and particularly the US. In Asia, and so where are we today? And today you have valuation levels in the US are at the 97th percentile in the last 100 years, if you look at PE multiples, which implies that going forward, public market returns are going to be something like 3% per annum. So the idea that you can continue to make money from just pure market beta and multiples expansion is going to be harder to come by in the developed markets. And what we see in Asia, and what some investors are looking for in Asia, is what we call true alpha, the ability to generate returns regardless of what's happening in the public markets. And there's 4 things that we tell our investors are really interesting about Asia when it comes to generating real alpha, independent of market beta. Number 1, we have much higher growth in this region. So if you look at the kinds of companies that all of us are investing in here on this panel, say healthcare, for example, look at healthcare spend in India as a percentage of GDP, it's 3%. In the United States, it's 17%. There's a huge gap, and there's a tremendous amount of growth still in, say, healthcare in India and many other sectors, software and others. So growth is really one key driver of returns in our region. Number 2, we have a lot more undermanaged assets in Asia as a result of the fact that there's still a lot of inefficiency in the system. You look at a market like Japan, which is one of the markets that we are very active in. There you have over 1,000 companies trading below book value right now. And the government there is quite serious about improving shareholder governance and improving the efficiency of these businesses. And we can talk more about Japan later, perhaps. Number 3 is that there's also a kind of uncorrelated pools of liquidity in our region, which enables investors to get capital back when other markets are shut. Last year actually was a very big exit year for us out of our India program at a time when the US market was not delivering a lot of distributions because the markets there were shut. And then lastly, I would say that our region is still underpenetrated in terms of private assets. If you look at total global private equity allocations out of institutional investors, about 6% of global allocations come to Asia. 94% are going to the developed markets. Yet we represent half of the world's GDP. We represent 60% of global GDP growth in this part of the world, but we're only getting 6% of the capital. So even though our markets are competitive, there's still, I think, an imbalance in the region. And this is, I think, what's attracting investors to the region, this idea that you can generate this excess return in a world where you're going to really have to look for growth to generate returns rather than just rising stock markets.
Thanks, Sean. Very comprehensive. Lei?
First of all, thank HKMA for organizing this very incredible event. I'm very glad to be here. I'd like to also share a little bit, I agree with Sean, a lot of what he said about Asia being a under-penetrating market with uncorrelated returns. But a couple more things I wanted to highlight. One, if you invest in real private equity, this is the market you really stay close to the real economy. This is not about leverage. This market, we look at our returns historically, the leverage in Asia market is multiple lower than the rest that of the US and Europe. So you see rarely the opportunities for Asia private equity just being leverage and cost cutting and get financial engineering. This is not a financial engineering market. This is a real economy market. That's one. 2, I think you are seeing a lot more entrepreneurship in this market. That you do see mature market when you have great management, entrepreneurship, and you could cut both ways. You get the entrepreneurial drive, you get companies to really have a lot more innovation in the marketplace. At the same time, you could also leave a lot of room for private equity to do mature management and helping entrepreneurs in the right place. So I think this gives you the opportunity for investors to access totally uncorrelated return, I would argue, with much lower risk, both out of leverage, and also out of the multiple expansion. You don't have that high multiple expansion risk you see in other marketplaces.
Thanks, Lee. So it sounds like growth and innovations are some common themes that I've heard. So Lisa, may I turn to you? So Qiming focuses very much on early stage venture capital. And valuation of startup has adjusted quite substantially around the world, not just in Asia. Besides valuation, cash distribution to limited partner is another top of the mind issues I assume for your investors as well. Besides these challenges that we have seen, what opportunities are you seeing broadly in venture capital? And how do you keep your investor happy in an environment like this?
Thanks, Samson, again, and thanks, Eddie, for this setting up this conference and inviting me. I think, the last, having done VC investing in China and Asia for 20 years, it's definitely a down cycle. I think the US dollar investment in China is down 85%, and Renminbi investment is down 70%. But I totally agree with Lei and Jean about entrepreneurship in China and Asia. I mean, 65% of our first money in has always been angel round and Series A round. And I would say that, we've invested in 550 companies. What's really interesting is that the companies, it's so entrepreneurial. When we first started 20 years ago, and I focus on healthcare, it's all black and white ultrasound machines and patient monitoring system. Now, when you go to any of the medical conferences, anything that you can see developed in the Western world is available and developed in China and for the world. So, about 40% of our healthcare companies actually have offices and headquarters in US already. So it's really amazing what the entrepreneurs have done. But back in 2021, I think, when it comes to cash distribution and how to weather the current state, back in 21, I told the team not to invest in any pre-IPO deals, just because the market for the whole pre-IPO has been so crazy. So we stayed away from that. We continue with our core to invest in angel and Series A round. But because we went through a few cycles where A-share market actually stopped allowing IPO, back in 2013 to 2016, I still remember there was one of our companies filed IPO back in 2012, and they waited for 3 years for IPO. So as soon as the IPO window opened, we're like, okay, let's get the companies out for IPO. So we've had 42 IPOs since COVID, and 30 of them are in healthcare. So I think we're very fortunate to see that Hong Kong Exchange introduced the 18A and 18C. This really allows a lot of the Chinese and Asian entrepreneurs to be able to raise additional funding to further the development and R&D, as well as global expansion. So as a result of these IPOs, we're able to have record number of amount of DPI for our investors in the last couple of years, and probably in the next couple of years as well. But in the meantime, because the valuation has decreased so much, and because the funding has decreased so much, it's actually a really good time to invest in startups. So, we see that the valuation on average for Series A has dropped probably about 30–40% in the market. So this allows investors like ourselves to actually be able to participate and really spend time looking at how to help these companies.
Thanks, Lisa. May I stay with you for another question, since we are on this topic? When it comes to biotech, I think there's still a lot of innovations going on. And I understand there has been a notable surge in out-licensing deals that's happening in biotech in China right now. So can you share with us what are the driving forces behind these type of transactions, and what are you seeing right now generally?
Yeah, so it's actually a very interesting trend. We would never have thought before COVID that this would happen, but in 2023, there were 96 licensing deals, Chinese assets, own developed assets, licensed by MNC or biotech companies in the US. 3 days ago, we just announced one of our portfolio companies licensed their bispecific PD-L1 to Merck for $700 million upfront, a $3.3 billion US dollars drug. So I think it's really interesting to see that MNC are starting to recognize the innovation coming out from the Chinese biotech arena. And, but, I think the companies are also deciding, do they want to, the fact that it's a little bit harder for startups to raise next round, sometimes they would be licensing out the third or the fourth best assets to MNC for global and maintain the first 2 or 3 assets. So they can use the upfront payment to continue with the clinical trial for global. So, and then, eventually the companies can go public. So I think, this is a very exciting trend. It's really exciting to see the type of innovation. We've seen a whole barrage from ADC, cell and gene therapy, bispecific, and lots of different areas that Chinese entrepreneurs have successfully developed.
Thanks, Nisa. Sean, I'll come to you. Let's switch gear to buyout. Relative to US and Europe, Asia has skewed more towards growth investment historically. And the way I see it, there are probably 2 key drivers. First, Asia's economy was more growth-oriented. We talked a little bit about that. Second, private equity buyout was probably not well understood by some of the local markets before. So as a buyout manager, what's your latest observation? And do you think Asia is maturing as a buyout market right now?
Yeah. Well, the Asian buyout market is growing. In our strategy, we view private equity essentially as a governance strategy. It's about governance. We control every company that we invest in, we will control the company. Why do we want to do that? We want to do that because of really 2 things. One, we want to control the value creation of how we transform the business, and we also want to control how we exit the company and the timing of the exit, and so that we can get liquidity on the investment. And I think the buyout market, which, you're correct, historically was really not very large in Asia. I started in this business in the early 90s. I see Edmund's in the audience. I was at AIG Investment Corporation in like early 1990s, doing private equity in the days when there was only minority investments really available. But the market has changed, particularly I'd say in the last 10 years. And we now are seeing really quite a large buyout market developing. To give you some numbers, when we first did our first buyout in India in 2013, it was a $2 billion buyout market that year, and we did a $200 million deal. We were 10% of the market. Last year, there were $10 billion worth of buyouts. And the forecast, if you look at McKinsey and Bain estimates, is that that's going to a $50 billion buyout market by 2030. And if you look at the core buyout markets that we focus on, which would be Japan, India, and Australia, those 3 markets last year were about $75 billion of transactions. That number is going to be something like 165 to 180 billion by 2030. So it's going to double, and it's going to become actually quite a substantial market. And I think actually what's interesting is that being based in Hong Kong, I think this is the perfect place to cover the entire region as a buyout investor, and it's really a perfect hub. And we've been based here for now 27 years as a firm, and we have an $11 billion buyout fund. We're raising a larger fund at the moment, and it's a market where you have a lot of connectivity to what's happening around the region. So we feel like this is actually a good place to run the business from, but having local country teams covering the markets in each of the areas that we invest in. But overall, we're actually very positive about the markets, the buyout opportunity, and we think it's going to continue to scale.
Thanks, Sean. So next, I want to talk a bit about the China private equity market, because as we all know, China PE historically was half of the region's investment activities when it comes to private equity. Now, China, the headline GDP has slowed, but having said that, it's an $18 trillion economy. We all know that. So there must be some interesting opportunities in China right now. And I would like to make a comparison versus Europe. While the headline GDP there is 1% or less, but I've seen a lot of private equity firms making strong double-digit return in Europe right now. Now, so this is for Lei and Lisa. China has launched a series of additional monetary and fiscal measures, as Professor Huang has told us the proper terms to use about these new measures announced by the Chinese government. Now, given your experience investing across cycle in China, can you share with us your outlook of China from a private equity and VC perspective? And in particular, if you could just focus on the domestic market in China for now, What are some of the sectors that you're thinking that are interesting? Lei, perhaps, can you go first?
Sure. I'm not a macroeconomist, so I'm not going to focus a lot about, the macroeconomy, the sort of the economic growth. I think there's a lot of positive news that we saw, and even we hear yesterday there's many more stimulus package coming. I'm sure there's going to be multi-leg. There's going to be much more stimulus on the way. But first, I wanted to remind everyone, in the end, we are bottom-up investors. If you observe, interestingly enough, almost the best businesses are born and made in the most difficult times. And do you guys know when AWS was founded? 2003, 2004, when internet bubble burst, 2002, and at the age of 2003, 2004, Amazon's existence was called into question. And do you know iPhone moment? That's 2008, 2009, right after global financial crisis. Now you look at Japan, in the so-called lost decades. Amazing company from Itori, Uniqlo, incredible company were formed. Nippon Paint, and not formed, but grown out of that. So I really want to remind you that as such large economy with brilliant entrepreneurs, with this drive and resilience, I couldn't think about a better environment for stress testing the best entrepreneurs. And I'm sure 20 years looking back, these are going to be greatest businesses, entrepreneurs in the making.
Thanks, Lei. Lisa, do you have anything to add?
I agree. Now, I think the best return deals that we've ever made during these difficult times. But what's really interesting is the entrepreneurship 20 years ago versus now. I think there's so many, we're generating so many engineers every year. And a lot of these engineers grow up with a lot of the new technologies around them. So we're really starting to see smart manufacturing, consumer tech that are using all types of AI, biotech, healthcare. So we're seeing a lot of really interesting new business models that we would never have imagined 5-7 years ago.
Thank you. Lei, so one of the key trends we are seeing in the recent past is that many Chinese companies are going out. And many of our speakers yesterday spoke about the China +1 macro theme that's taking place in Asia right now. Can you share with us what you are seeing from a private equity standpoint around this China +1 theme? And what does it take to be successful in this particular strategy? And what role do you think Hong Kong could play in this regard?
I think this is a massive opportunity. Because from China perspective, also there are a lot of those entrepreneurs, their businesses, many of them are global in nature because they're the best in what they do on global supply chain. Increasingly, I'm seeing that particularly going to Southeast Asia, ASEAN countries from the whole EV battery supply chain, energy storage to consumer goods company even earlier. So I'm seeing a lot of those entrepreneurs. By the way, the technology internet guys did that before. So when we first invested in the e-commerce companies and logistic delivery companies, and looking back, we brought the talents from Meituan and JD, and they worked on our investment in today's Shopee. And 10 years ago, when we first made the investments, today Shopee become a dominant Southeast Asian player, and then you're seeing that similarly with Grab, with the EV battery supply chain, you're seeing that many more companies repeating this game. I think the key success factors, it's about the best entrepreneurs going around and dedicate their efforts. I think Hong Kong is well positioned to take advantage of that because they need a sort of regional headquarter or global headquarter for them to build not only international capital markets and attracting capital. They can get it anywhere, but really building on a talent base and an international hub. There's no, we were talking with one VD company in the hinterland of China. There's no way they're going to be able to recruit the best talents who are English-speaking, able to penetrate into the ASEAN countries. And now Hong Kong is the perfect place for them to build a regional headquarters and also expand overseas, bringing talents over. And increasingly, I also see they use Hong Kong even as a research hub, as there are more and more universities, Life Science Park, have a dedicated program for that. So I think there are a lot of opportunities, and we're just at the very beginning of this.
Right, thanks, Lei. So Sean, I think some of our speakers have briefly talked about India. And India is playing an increasingly important role in Asia's private equity deal activities. And it's accounting for roughly 20% of the transaction volume today. And a few of the sectors that have been quite popular for private equity investment in India include healthcare, manufacturing, IT services, and consumer. I know EQT is quite active in India as well. Can you share with us the driving forces behind the increasing interest in India? And what should we be worried about when investing in India?
Yeah. Well, we've been on the ground in India since 1996 and investing there since then. I think the market has come a long way and has evolved into a really interesting opportunity. I mean, at a macro level, India has 1.4 billion people, half of which are under the age of 30, so 700 million people. They are essentially all looking to get an education, to get better health care, to buy their first home. So if you look at the thematic investing, which is really, we're very thematic investors and looking for long-term structural growth drivers in our investment strategies. You know, one of the key areas that we're focused on is healthcare and healthcare services. For example, we just acquired the largest fertility clinics business in India, the IVF clinic business. They have a 50% market share across the country and it's growing. We just acquired the largest student loan business in India that's helping students get an education and go abroad to get an education. So these are really, I think, long-term structurally growing sectors of the economy. And that's kind of the domestic part of the India story. But there's also an export global part of the story, which is even more interesting to us in many ways. And it's actually a larger part of our investment strategy, which is the whole tech services industry. The tech services industry is basically a play on two things. One is the global technology spend, which is just a long-term growth trend that started with, you know, Y2K, for those of you that remember that, in 1999, you know, that all computers are going to blow up in the January 1st, 2000. That's how the Indian tech services industry began. But then it got into the internet, and then it got into cloud and mobile and cloud migration, and now it's AI that's driving tech spend in India. So it's a play on tech spend, and it's also a play on talent and the amount. You know, there's something like 3 or 4 million computer scientists in India, English-speaking, highly trained, and they have a deep pool of talent that continues to come through the school system there. So the matching of the talent pool with the global spend is a very interesting long-term thematic that India has been able to capitalize on. And that industry now is something like a $300 or $400 billion industry, and it continues to track well. And there's a lot of buyout opportunities in tech services. I think if you talk about what could go wrong and you know, what some of the issues are. I think one of the key drivers of India's development has actually been its positive business environment driven by the positive political environment under Modi. And Mr. Modi, I think, has been able to create an environment that's business friendly, that is fairly consistent in terms of its policy towards the business sector. And I think as long as that continues, we'll see things continuing as they are today. But if that were to change, I think that would be a risk. One last comment I'll make about India is that India used to be a tough market to exit from, to get liquidity from. That's also changed. And the reason it's changed is because the stock market has become so deep. It's a $5 trillion stock market, actually. That's a pretty large market cap for the stock market. It's like 4th or 5th in the world, slightly, I think, behind Hong Kong. But it's a deep market. And it's basically a market that is now driven by domestic savings pools, whereas previously it was largely driven by foreign investment income. There's something like $40 billion a year of new inflows going from the middle class savers who are essentially investing their savings into the stock market, that's creating a very nice investment and exit environment for private equity investors.
And Sean, Lei, I actually want to ask you one more question because I checked the questions from the audience. So yesterday, I think we talked about private credit again. So Mark Rowan and Howard Marks talked a little bit about it. And the key takeaway I got is there's no private or public credit. There's just credit. Now, I just want to ask you a quick question. The traditional banks in Asia are still the dominant credit providers in this region. And what is your own outlook of Asia credit or private credit?
Yes, I think banks still gonna play a critical role in Asia. Even in private credit or public credit, they're still gonna be a facilitator, because a lot of that is about business relationships. We think about credit just another way to express a business relationship. In that regard, banks are well entrenched in all those business relationships. But what I see banks are, they're very, very good at sort of financing solutions related to trade or transactions. But for banks to make a multi-year bet on the credit quality of any counterparty, I think it's very hard. I think that's actually the skill sets what people like John and us and Nisa, we would make. Say, hey, this is a multi-year bet. We think they're gonna go well or not. I think increasingly you're seeing banks, we have a private credit strategy now doing really well. The first half we already developed quite large amount of capital. You're seeing that banks a lot of times actually are partners with us because they are facilitators in the transactions, continue to provide working capital. They actually get even more confidence on the company that we selected to be our private credit portfolio companies because it's another verification, another portfolio management, constant portfolio management as us, as the investor into their businesses. So, and I think anything that had to do with a multi-year bet, with a longer duration, with betting on business nature beyond just owned by the real assets, that's actually investors have an upper hand, but investors would love to work with the banks to for that what I call really the total capital solution to the real economy.
All right, thanks, Lei. So I think we have time for one question from the audience. We are seeing rising opportunities in the Southeast Asia market for some time, but illiquidity and fragmentation are still challenging. Can you share with us your view about the opportunities in Southeast Asia? Well, Sean, you want to take a go at it?
Quick answer. We agree Southeast Asia is super interesting. It's an area of focus for us. We actually just acquired the largest online classified real estate business that was listed in Singapore called Property Guru. It covers Malaysia, Thailand, and Singapore and Vietnam. And it's an online marketplace. It was about $1 billion transaction. We love marketplaces. We think they have really interesting kind of almost winner-take-all economics. And I think there's going to be more activity there, but I agree with the point that it is a more fragmented market, and it's harder to find scale opportunities there given just the geography. It's probably slightly earlier in maturity as far as controlled buyouts are, but I think there's a lot of interesting growth and venture opportunities in Southeast Asia that I'm sure my colleagues invest in more than we do.
Okay, great. So I think that's 30 minutes. And thank you, Lisa, Sean, and Lei for the very interesting insight and discussions. And may we give them a round of applause. Thank you.
Thank you very much, Samson, also for moderating that discussion. And can everyone come to the front and middle for the group photo, please? 2 sets of photos, one for our official photographer, who's on the ladder there. And the next round for the media photographers who are at the back, slightly to the left. I think they've got the shot. Thank you so much again, Samson, Nisa, John, and Lei. Thank you so much. Okay, we are going to take a very short break of 15 minutes. There is coffee, tea, and refreshments outside there. Please be quick on your feet to be back here at 11:10 so that we can begin the next session. Thanks, everybody. Enjoy your coffee. Hi, ladies and gentlemen. Once more, please come into the main hall and take a seat as we are going to start our panel discussion very shortly. Please come on in, bring your coffee and tea if you like. Find a seat so that we can start in just a few minutes. Thank you. Welcome back, everyone. Thank you for coming back in so promptly. I hope you enjoyed your break and are ready to settle in for some more great conversations with our global investors. Now, at last year's summit, we had a panel of hedge fund managers who shared how they navigated volatile markets and where they saw risks and opportunities. This year, we also have a panel of top investment managers, and they're going to tell us how the global investment outlook has changed since then, and also give us their latest assessment of where it's going. To moderate for us today, we're delighted to have Mr. Albert Goh, Chief Investment Officer of External Managers at the Hong Kong Monetary Authority. And he's joined by Chris Graddle, Co-founder and CEO at PAG, Bob Prince, Co-Chief Investment Officer of Bridgewater Associates, and Michael J. Sachs, Chairman and CEO, GCM Grosvenor. So please give them all a warm welcome.
Thank you very much, Karen. So welcome to the panel on risk takers. My panelists need very little introduction. I'll go through them quickly. Chris Graddle, founder and CEO of Asia's largest alternatives manager, PAG. Bob Prince, co-founder and CIO of the world's largest hedge fund, Bridgewater. Michael Sachs, chairman and CEO of the world's largest alternatives fund of funds manager, Grosvenor. Please give them a hand. Let me just kick straight off with something on all risk takers' minds, the US elections. Michael, you're first up. We were told that it will be a very close fight. Even Taylor Swift and Elon Musk had to take sides. We even moved our own summit to now and November, just in case there were recounts. But in the end, we had a stunning Republican clean sweep. Michael, I know you're a blue blood Democrat. What went wrong for the Democrats? If you could just roll back 6 months, is there anything that the Democrats could have done differently?
So in the interest of full disclosure, Chicago was privileged to host the Democratic National Convention this summer, and I was privileged to chair the host committee for that convention, which was a lot of work. It, I think, worked out very well for Chicago. It was a nice 4-day commercial for the city, and everything really went well. It was probably the most successful Democratic National Convention that we've had in 50 years, maybe ever, which accompanied one of the least successful elections we've had in quite a long time. I think with the benefit of hindsight, there were a number of factors that made this a tough election for the Democrats, despite polls that showed a close race. And it was a decisive victory. I believe 48 out of 50 states, Republican vote share increased. In my state of Illinois, where President Trump lost 2 elections by near 20 points, he again lost this year, but only by 8 to 10 points, 12 points, something like that. So major shift, even in the true blue state of Illinois. When we look with the benefit of hindsight, we had what people call a wrong track election, where 67% of America thought the country was on the wrong track. We had real impacts from inflation that made, despite some wage increase actually, made economic condition challenging for people in particular, for young people, but really for everyone. You had an immigration problem. You had two wars. And then you had a process by which President Biden stepped down, Vice President Harris was nominated, that took place inside the Democratic Party and didn't really involve a normal primary where the public got to know the candidate well, got to understand the policies, and where there was, frankly, some competition amongst candidates for ideas and for communications. So when you look at all that, I'm not sure that it's the outcome of the election is a huge surprise, and I don't really think that there's anything that could have been done 6 months ago that would have changed that. Had President Biden stepped down 18 months ago, maybe even 12 months ago, had you had a full open primary, multi-state, you still would have had those fundamental issues of inflation and immigration and wars. You still would have had a wrong track election. But it's conceivable that some candidate, perhaps Vice President Harris or a different candidate, could have connected with people, communicated through. But with the way that things went, I think it's not a surprise, and I don't think there's really much that could have been done in a 6-month period.
Okay, very good. I'll switch over to Bob. Bob, many of your alumni held senior positions in government, and your former CEO will soon be a Republican senator in Pennsylvania. So you must have an inside track within DC. As the election smoke clears, which is the title of one of your videos, what impact will the new administration have on the economy and the markets?
Well, I think at this point, there's just a massive amount of, good point. I think at this point, there's a massive amount of uncertainty, obviously. Donald Trump, that's his currency. He creates uncertainty intentionally. But, and so in the near term, that's obviously a negative for the markets. Markets don't like uncertainty. But as you look at the policies are probably going to be pro-business, but they're probably also going to be pro-inflation, which creates kind of an interesting problem because there's a desire for a cut in interest rates, but if the inflation rate holds up, then that can preclude that cut in rates, which I think sets up an interesting situation in 18 months from now when the Fed chair comes up for a new appointment. And so as you sort of project out the policies, which tariffs, fiscal stimulation, and constraining the workforce, those all sort of push toward us not getting to the 2% target inflation rate. And then if we come in here 18 months from now and we're not quite, settled at the 2%, what if we're settled at 3%? There'll be a certain amount of inclination to have a Fed chair that would accommodate that, right? Given Trump's making the nomination. So he would, at that point, want lower interest rates anyway, and then you get a steeper yield curve and so on and so forth. So, and at the same time, you have the debt problem that we've all talked about, which has not been a problem so far, but it lingers out there in the future. I think if you put all of those things together, it creates a likely economic scenario which is, I think of it as a higher nominal growth environment where spending actually stays higher. Household balance sheets are in pretty good shape, and there was a substantial deleveraging over the prior decade, which allowed for that. Wages are pretty good, and a lot of the spending has been financed by income, not credit. So you have the ingredients, actually, with the fiscal stimulation continuing to have a somewhat higher nominal growth environment in the future, which precludes the degree of interest rate cuts that people were looking for before. Maybe causes bond yields to drift up some to get a little bit of a risk premium there. But I think with respect, but actually supports equities because that nominal growth, that nominal spending is revenues, and if for companies that have pricing power, that can flow to the bottom line, and that automatically gives you sort of a nominal growth of earnings. And then if you could buy it at a decent yield, that's actually not a bad expected return. The challenge in the equity market is that the last decade, which was so fantastic for earnings, is fully priced in to happen again. We just had probably the best decade in history for earnings and one of the best for stock prices. And now the markets have discounted that and more for the coming decade, right? So that is going to be a challenge. So I think it for the market in general. But inside of the equity market, you do have these beneficial characteristics of probably a reasonably favorable nominal spending environment. So it's a highly uncertain environment for now. We're kind of at low risk. Probably in time, you have those conditions, and generally favoring an environment is better for stocks than for bonds. But we'll see. We'll know more in 6 months.
All good for us. Let us move on to China. Chris, your recent deal involved buying over 500 shopping malls in China. You are now the world's largest manager of shopping malls. Some say that you're absolutely crazy. You know that they have online shopping in China, right? But now, it looks like you bought right at the bottom of the market. So you are an absolute genius, a fine line between crazy and genius. What is needed to attract more investors like you?
I guess, we're maybe taking a step back first, and I'll come to that. We're sort of as a regional firm, we're constantly looking across the region where the opportunities are. And honestly, in a market as big as China, there's always going to be something to do. And the areas where we've been active, most active in China recently, being on the public equity side, on the hedge equity long short. We also launched actually a long-only China product because we felt valuations were reasonable on a medium-term outlook. And actually on buyouts in China, where we actually feel that valuations are reasonable, where financing is available at reasonable prices, some of the cheapest financing in the world now. We actually think we can buy cash flows at very reasonable prices. So, that investment, it's the biggest buyout ever in China. It's the biggest buyout financing package ever done in Renminbi with local banks. So it's, I guess, a reasonably big bet. But we feel, it was done, it's a great business. with very, very predictable cash flows. And these are mass market malls, which focus on where people spend their weekends, F&B and kids entertainment and all these things. Yeah, we think we got a great deal. But as you know, as we talk with our investors, I guess they fall into three groups. One is absolutely no way China, and that's mainly driven by geopolitics. And you know, I think as somebody who believes in the benefits of globalization, I think it's sad that we have that, but it's probably not going to change in the short run. Then we have the people who are on the sidelines, which is probably the bulk of investors. And you know, I think they are sitting on the sidelines because probably for you know, three main reasons. One, waiting to see what happens with the economy. I think it's very, very important that the government continues to support the economy, and that you know, I think they're very good signs, green shoots, that the economy is recovering. But I think they need to not take their foot off the gas pedal, you know, so that recovery can still be fragile. So I think that's important, and people want to see that. I think secondly, you know, to be frank, performance of people's China portfolios in the last 3 years has been challenged. You know, most asset classes, you know, people lost money, and many investments are still stuck in China. And, you know, I think people want to see, it's very, very important that the IPO market sort of reopens, that M&A gets restarted again. And you know, I was encouraged to hear Mr. Wu of the CSRC yesterday stating that this is something they're trying to do. But we need that dynamism. So people need to see their existing investments cash coming back, and need to see there's ability to make money. And I think capital will come back, because I think most investors are pragmatic and see that this is a huge part of the world economy. And then the third group are the people who are leaning in. And, you know, I say the Middle East is probably the biggest part of that, you know, who really see two things. One, contrarian, think there's a lot of value there today. And secondly, you know, it's interesting, the US is no longer a big customer for the Middle Eastern oil. I mean, that's a fact. And I think, you know, talking with clients there, they don't want to take sides. They want to be unaligned, and they are underallocated China and the East and Asia. And I think, you know, we're seeing strong capital flows into the region from that part of the world, which is obviously, we think is good. So, you know, I'm optimistic that if these things can be addressed, then capital will come back.
Please continue to lean in. Bob, the Bridgewater All China Fund has been a huge success, winning the Golden Bull Award 3 years in a row. So you're a foreigner making money in China, where many have failed. So you clearly have an inside track, again, with the Chinese policymakers. What is your secret sauce?
Well, it's not the policymakers. Yeah, we're pretty far out on the tail of a contrarian on China, I think. And in fact, our global portfolios, we've been overweight China. And the returns inside of China have been good. But I think you have to recognize that how we actually go about that is we do it in a certain way, which is that we start with a balanced portfolio across assets, meaning the risk is balanced across assets, where we try to neutralize some of the macroeconomic influences and just really isolate the portfolio on liquidity conditions and risk premiums in the country. And so within China, that's actually been very beneficial, because given the weakness of the economy, coming out of a period of weakness, deflation, and so forth, it's actually encouraged, and then with the pullback of liquidity back to US, risk premiums are up, then when you inject liquidity in that environment, asset returns are good. But the composition of those returns, if you look across a balanced portfolio's done well, but the composition of those returns has been much more in the bond market. And it's much more in the commodities markets and not in the equity market, right? Because the equity market was hurt by the weak growth, but the interest rates actually more than offset that if you balance your risk across those assets. And then with the policy shifts this summer, or in September, you know, where it manifests shifted from the bond market to the stock market, but you're still getting that, on average across assets, you're still getting the benefit of the accommodative policies and the low interest rates.
Well done. Hope you win the next Golden Bull. Let us move on to Hong Kong. As I did my research for this panel, I discovered a strong connection between our panelists and Hong Kong. So Bob, sorry to put you on the spot. In Hong Kong, property ownership is a matter of public record. Everyone in Hong Kong will be delighted to know that you have just bought a mansion in prime Hong Kong, Kaduri Hill to be exact. Robert Ng says that it's the most exclusive location in Hong Kong. Please give Bob a hand. You bought at a time when sentiment for Hong Kong property is still weak.
Everyone's invited for dinner.
Bob, CIO of the largest hedge fund in the world, please share with us your investment thesis.
Well, my wife loves Hong Kong. I can't believe how much of a conversation topic it is that you bought an apartment somewhere. But anyway, no, I mean, I guess the very, very short rationale would be, you know, solid fundamentals, negative sentiment. And from an investment standpoint, that's always a good combination. But I think as you kind of go beyond that, I'm not a real estate speculator, so that's not really nearly enough. But I think from a business standpoint, Hong Kong is what it's always been, really. And I think that the prospects, even for Hong Kong in relation to Pan-Asia, are tremendous. As we get, you know, expansions in capital markets across Asia, you go across Asia, Asia is really vastly under-securitized. And there's potential for Hong Kong to play a very important role in that. So there's a lot of potential growth there. I think when you look at the Greater Bay Area, it's a fabulous concept. Like, imagine that you put Silicon Valley next to New York and tied them together somehow. Like, that's a dynamite combination, and that's a little bit of what's I think out there. And then I think from a personal standpoint, from a Bridgewater, you know, business standpoint, we do business from the north to the south of Asia, and we have great clients, long-term clients all along, and Hong Kong's right in the middle, right? So everything is accessible from here, great new airport, and then literally from a personal standpoint, fun, great city, great culture, great restaurants, but the final test was I did bring Sharon here, and she loved it, and so we're like, done.
That's a good reason. On behalf of all Hong Kong homeowners, we thank you for lifting up the market sentiment. But Bob, you were outdone by Chris.
Yeah, but he's an insider.
Chris, I read in the South China Morning Post that you recently dropped over $500 million to buy one of the largest houses on Hong Kong Island. I'm starting to see a trend in your bottom fishing. Please share with us your outlook on Hong Kong and the market.
Well, okay. I was going to say, but it sounds a bit ridiculous now. I was going to say, you know, by philosophy, I'm a value investor. And people who understand Hong Kong property know there have been very, very few bargains and very little value in this market for a long time. And, you know, I think the market obviously has come down a bit, and, you know, my wife and I, and, you know, having lived here for 24 years, probably was about time that we actually bought something. So we took the plunge and bought I think a very interesting 100-year-old property.
It's amazing, yeah. Thank you for putting the mojo back in our market. You know something, actually, both of you were outdone by Jean Salata from the previous panel, but that's another story. Michael, if you feel left out, we have colleagues.
I want to see if I can find a real estate broker for the panel.
We have colleagues from our land.
Send recommendations.
Yeah, that's right. We have colleagues from our land department on standby, and they will show you some exclusive land parcels. Yeah, no problem. Okay, let's move on. Let's move on to talent and succession. Bob again. So Bridgewater has managed succession extremely well. There was a smooth transition from Ray Dalio to a new management team. And you have now groomed Karen Cornell-Temple from your intern to now your co-CIO. You know, this is at a time when many founders will simply fire potential challengers or sell themselves to BlackRock. Please share with us your philosophy and culture. How do you groom your talent?
Well, first of all, we have 2 co-CIOs that started as interns at Bridgewater. So Greg did as well. So, well, I think, you know, I think there are a few key ingredients behind that. And I think it really actually starts with actually how we manage money. We have a fundamental systematic investment process, which means that we pre-specify all of our criteria for decision making. And from a knowledge transfer perspective, that can be handed off to the next generation and built upon. So you're not starting all over. I think a second thing is culture is super important. And the culture is an environment, we're explicit about the culture. And so the culture is sustained over time. And that supports transition. I think also those things also lead to that we've had a lot of longevity. I've been there 38 years, Greg's been there 28, Karen's now 18. We're bringing the next generation along. And I think 30% of our workforce has been there more than 10 years. So we've had a lot of longevity. That is very good for transition. But I think, and then I think given that sort of foundation, it was also very important that, you know, Ray, more than 10 years ago, said, okay, we need to think about transition, and this is probably going to take a decade. And so it was a very intentional process carried out over the course of a decade plus, you know, from a number of different angles. And, you know, I think that's probably what it takes.
Congratulations. I'm sure Harvard Business School will do a case study on you, or probably already have. Michael, you work with many successful hedge funds and PE managers. What is the secret of their success in attracting and retaining talent?
Well, I think it's a sort of a variation of, a variant of that answer. To me, intentionality and culture. The reality is, it's a people business. It's a mobile business. It's a little bit like academia, where professors can move around, and so you really need to be intentional with regard to the your team, the development of your team, and planning for succession. We plan for contingency, which is frankly, you know, a little different from succession, and we plan for succession, and it's something that we work on with our leaders, and we try to have buy-in for. But it's really, to me, culture is the issue, because the economic opportunities for people in our world and in our universe, the alternative investment space, whether it's hedge funds, private market, are significant, and I don't think you do this by compensation. I don't think you can be successful by, you know, golden handcuffs. Those are fair compensation and proper structure are part of tight and strong and enduring teams. But it really is, to me, intentionality, planning, communication, and culture is critical.
Thank you very much. We have a few minutes left, so let's have fun with some quick-fire questions. The rules are simple. Do not think on your feet. Just shoot from your hip. There are no wrong answers, okay? First one. So the theme of our summit is sailing through changes. So imagine that you are the captain of a sailboat racing across the Pacific. However, a Category 5 hurricane is coming, or Typhoon 10 equivalent in Hong Kong. Now, thankfully, each one of you will be granted one trump card each. Can you pass it on, please?
What are we doing?
You can just hold on to them and then show them to the audience, one side. These are so beautiful. These trump cards are mega. They make everything great again. So you have a choice. You can either upgrade to the best sailing crew in the world, not any crew, but the winning crew of America's Cup, or you can upgrade to the best sailing boat in the world, not any boat, but the 500-foot unsinkable yacht owned by Jeff Bezos, or you can upgrade to the best satellite system for the best storm data. So not any satellite, but 10,000 Starlink satellites by Elon Musk. You may only choose one. Don't need to choose the one you're holding, but maybe I'll start with Michael.
I'll actually go with the one that I was handed, which is best crew. And I think that an experienced, incredibly capable team is very, very valuable.
Thank you. Bob?
I'm not going with Jeff Bezos and the biggest boat. I'm going with the best crew. It's not what you got, it's what you do with what you got.
Ooh, okay, very good.
I'll go with the best boat because I think even a good crew in a small dinghy is going to have a tough time. So, and there's probably some good wine hidden somewhere on that boat as well. So.
Good choice. I'm a data person, so I always go for the best data because with the right data, you just stay in port, don't go out, have some nice cocktails. Yeah. Next question. What will be the biggest surprise of 2025? What is the biggest thing flying under the radar screen? What will surprise us next year? Michael?
So I think there's an expectation of significant change, great change. I think that we're talking about massive change to the economic structure, and that's maybe an expectation now with tariffs and significant cuts in tax revenue and significant changes to the size and scale of the government in the United States. We're hoping for, and I'm certainly hoping for, an end to the wars that we've seen over the last several years. And there's been an expectation, I think there is an expectation that maybe those will end quickly. And to some extent, I think that the biggest surprise might be that when we gather a year from now, there's not as much change as we are expecting today. That figuring out what happens to tax policy in the United States is not easy, despite the strength of the election victory and having both chambers of Congress. That type of change, order of magnitude change to the size of the government and the government services is not easy, no matter how brilliant and aggressive Elon Musk may be. That is just not easy to take, 2, 3, whatever the number is, $1 trillion out of the government. So I think there's a shot that we're sitting here in a year and there is less sort of, and God bless, let's hope that we can end the wars that we've seen. But those aren't simple situations either. So my fear is the surprise is we sit here a year from now and there's not a lot of change that's occurred.
Okay, this is a quick fire question, so we need to be fast. But thank you for that.
Yeah, I see over. I'll give you the short one. Just better than 50% odds on a rational president.
Oh, okay. Chris?
Well, I hope it'd be great if we saw peace in Europe and peace in the Middle East. I think that would be great. I think having been in New York last week, I was really surprised. I mean, there was a lot of bullishness about the positives and pro-growth, etc. But I think, you know, if inflation really comes back like next year, I think there's going to be all sorts of interesting things happening in markets.
So we're all sounding like Miss Universe candidates. World peace, world peace, world peace. Great. Okay. Next question. Knowing what you know today, what is one advice that you will give yourself 20 years ago?
Knowing what we know today, it's got to be get levered long and hold on, right? You know? But aside from that economic piece, I think take a little more time. I've been here regularly for a long time and all over the place, and I do wish I had spent a little bit more time, bought an apartment, something like that, and that would be the advice I'd give a 20-year younger person.
That's right. Bob?
Private assets.
Good. Chris?
Well, I think, you know, the biggest, and Steve Schwartzman said this to me once, you know, if you build a new business, only bet on a 10. And I think, you know, where I've made mistakes along the journey, it's been generally about, you know, people. So I think, you know, yeah, absolutely, particularly if you diversify in this business, you have to have absolutely the best people.
Yeah. Very good. So knowing what I know today, after today's panel, buy the biggest house in Hong Kong 20 years ago. It was SARS. It was a great time to buy. So good one. Last question, quick one. Share a special skill or talent that you will do in private that few people know about. Please keep it clean. We've got a room full of regulators here. Michael.
Well, I'm not sure it's a special skill or talent, but the thing that I think would most surprise my team would be to see me with my one-year-old granddaughter, you know, rolling around on the floor, talking in silly voices, and putting on puppet shows. So I think
very good. Bob?
I'd say the talent is only moderate, but I play trumpet.
Oh. Chris?
I spent a long time thinking, and unfortunately, I'm incredibly mediocre at pretty much everything. But maybe something that some people don't know. With some friends, 15 years ago, we started and built a music festival, which has become the biggest music festival in Hong Kong,
wow.
which starts next Friday. So please all buy tickets and come along.
Fantastic,
yeah.
Fantastic. Well, I love to cook for my friends and family because I think politics divide, but food unites. All right, thank you very much. You've all been great panelists. Thank you.
And thank you, Albert, for hosting the most entertaining and full of best metaphors panel of the day. Can we have you all come to the front for a group photo, please? Now that we know where everyone lives, Chris, if you ever need to carpool, I'm just down the street in Sassoon Road, so. And please, another big smile for our media photographers who are at the back on the left. Thank you so much. Thanks again to Albert for that wonderful hosting. Thank you, Chris, Bob, and Michael. Now, believe it or not, I know we're enjoying ourselves so much, but we have come to the last panel of the day. And this is all about the opportunities and risks in the new technology era. So our speakers are going to share their technology transformation journeys, including how to approach growth opportunities in early stage AI business. They'll also talk about the impact on traditional investment strategies and the role of human judgment during the transformation process. They may or may not use ChatGPT to answer these questions. We'll see. So we have a wonderful moderator for us today, Mr. Cheng Leong, Chief Strategy Officer of the Hong Kong Monetary Authority. And our panelists today are Ken Hao, Chairman and Managing Partner at Silver Lake, Devon J. Perek, Managing Director at Insight Partners, David Siegel, Co-Chairman and Co-Founder at 2 Sigma, and Hemnan Taneja, CEO and Managing Director at General Catalyst. So please give them all a very warm welcome.
Well, thank you. Thank you for staying behind. This is the last panel, I understand, between us and Eddie and lunch. First thing first, we won't talk about real estate on this panel. First of all, let's welcome our 4 distinguished panelists to the stage. And then today we're going to talk about technology. So of course, when we think about technology these days, we think about AI, all these fancy words. But technology, in fact, has been transforming humanity for thousands of years. We talk about fire, or can talk about fire. I talk about steam engine and everything else in between. But of course, today, AI has been sort of the point of discussions for many people. And we have a great panel here. They all have first-hand experience in the technology and in the evolution and the trend of it. So perhaps I would start with Ken. Ken, you manage Silver Lake, large-scale private equity investor, buyout. So you have been through multiple, I guess, waves in technology investment. So can you tell us a little bit more to put things into context, and then sort of how different is this current AI wave is from all the others?
I'd be happy to. And Eddie will be glad to know he only needs to be thanked 4 more times. So thank you for the opportunity to present here for the first time. Well, I've been investing in tech for over 30 years, and I'm not going to start with the steam engine, but certainly over that trajectory, which I think most of you remember, when I started in the business, it was mainframes and PCs for home use, and that changed. We've seen these giant waves of innovation, starting with client-server, and then replaced by internet architectures, and then, of course, cloud computing and mobility in between, and these all built on top of each other. One architecture enabled another bigger trend. And I think for sure, the elephant in the room, both today and yesterday, was AI, and I think justifiably so. I mean, AI and cloud computing are closely coupled, and for sure, this is a tidal wave that I certainly have never seen in terms of scale, speed, and impact. And clearly, I'm not suggesting that all the money that's being thrown at AI is going to be well spent, far from, but it's a trend that we at Silver Lake think is powerful and sustainable, although it will be volatile. And so with respect to AI, I think you've got every single boardroom, every single management team, certainly I think every single investment committee thinking about whether AI is a headwind or a tailwind for any investment. I mean, that's front and center. And for us, shifting to private equity, we are a large-scale private equity firm. These days, especially given all the volatility, our strategy is to focus on a small number of very large-scale investments denominated in units of $1 billion out of a $20 billion fund. And so we are very careful about understanding risk and making sure we can protect our capital and also pursue the upside of the investment. And so I'd narrow our focus areas with respect to AI, in particular, into 2 areas. Number one is the gigantic tech infrastructure that we see being built. I mean, AI has the wonderful impact of being a gigantic upgrade cycle. I mean, I refer to it as the mother of all upgrade cycles, particularly in hardware and data centers. And so we have investments in 2 data center companies, one called Vantage, another one which is a UAE-specific company called G42, who are embarking on large-scale data center build-outs. And the key there, because a lot was talked about data center build-out yesterday as a private equity theme, I'd add on to that theme, it's going to be growing, but I do believe it's going to be volatile. And so our strategy is to, frankly, spend a ton of time with the most important hyperscalers who have, I think, the most professional approach, the most visibility on what they want to do. And so we spend, through Vantage and G42, a ton of time, particularly with Microsoft, understanding their roadmaps, frankly, getting fairly deep commitments and visibility on what they want to do and how our data center companies can add value in that regard. And there are other major data center customers, like the other hyperscalers, and certain other very specialized companies that we feel strongly about. The other arena that we spend a lot of time thinking about is enterprise software. Again, back to the phrase, mother of all upgrade cycles. Enterprise software companies who have a natural upgrade path to AI enabling their offerings and providing a lot of intelligence to their enterprise customers, we think is the path to the future. And increased growth rates, increased profitability, and all the goodness that comes from that, but also embedded in a company that's established and profitable, and even if it takes a little longer, still has an enduring returns profile that could be enhanced with AI. So those are the 2 areas that we focus on the most. It's not glamorous. We're not making some of the big early stage bets like perhaps some of my very talented colleagues here who focus on disruptive next generation companies. But we're trying to focus on companies that have a strong established baseline but can inflect to faster growth, better profitability with an AI tailwind.
So I guess very pragmatic kind of approach, focusing still in a way the very hardcore investment discipline, right? Looking at profitability, looking at how efficiency can be predictable in some sense. Now, if I may turn to Hamed, you're obviously in a more early stage. So like Ken said, you're very high risk. You're getting into areas probably people don't know what they don't know. So can you then share with us how you look at AI investment, how you manage some of these unforeseen risks?
Yeah, so I think about the whole AI movement as your input is the foundation models, right? So you've got all these models being created all over the world now, open source, some closed source, and your output is workforce transformation. That's the way we sort of think about what's happening with AI. And so the question is, what needs to happen in the middle so that the way we work in society can fundamentally change with these language models? So let's talk about everything that we need. First thing we need is, unless you assume that these baseline internet-based language models have all the understanding in the world, you have to build small models on top that are specific to the industries where you're doing the workforce transformation. So the understanding, and I'll come back to an example of all of this in a second, but what the role of AI is in industrial sector versus healthcare versus media, it's all different. And so you do need to sort of think about how do you specialize with closed-end data sets on the use of that AI. Okay, so now you have the small models. Then you talk about, well, how do we adapt those into the enterprise so that there's workforce transformation? First thing is, you can't just take these models and put them on a data center and all of a sudden they start becoming functional. In fact, this is one of the reasons that all these companies that have gone and done proof of concepts with AI over the last couple of years, no one's really figured out how to adopt it at scale because they're stuck. Why are they stuck? They're stuck because you don't have the data infrastructure that can actually take these models and apply them and make them usable. So there's all this innovation that's happening today at the data infrastructure layer. So now you have the small models, you have the big models on top, you have data infrastructure, and then you have to try to imagine what is your workforce really going to look like. You're going to have these digital agents that are doing stuff, and then you have human beings. And somehow work's going to change when humans are going to do some things, and digital agents are going to do the other things. And so the choices you make there are very important, going back to responsibility. Choice is, should the digital agent be the pilot or the co-pilot? Okay, like what level of responsibility are you comfortable giving it in the context of the severity of the decisions that are being made? So, and now think about all these things I just talked about. You bring them into an enterprise, and you have to do all the change management on top. What does your organization look like? And how are you going to build, what does culture mean in that company? So it's a fair amount of work that needs to get done. So I'll give you an example of where we have been doing this. So when the whole GPT thing came out, we do a lot of work in healthcare. It's about 20% of our business. A lot of health systems called us and said, what should we do? And we said, well, if you give us access to your data, we will go build a language model that sits on top of these internet models, small model, that you guys can use that's safe and can be used for the industry. 40 health systems gave us their data. We built this company we started last February, so about 20 months ago. And we took that data, we trained a language model that was specific to healthcare that sits on top of the internet models. And we said, okay, now how do we use it? And we decided the first use case that we're going to give back to those health systems was a agentic nurse. Okay, so in the United States, a nurse costs $90 an hour on the phone. The one that's checking on how was your procedure yesterday, or are you prepared for your procedure that you're about to have tomorrow, checking up on your elderly, $90 on the phone. And one of their key KPIs is get off the phone as quickly as possible so you can make the next call. So they're always in a rush, they're not very empathetic, they're being measured for efficiency, not efficacy and empathy. So this model, when we turn it into an AI nurse, cost us, we don't charge this, but it costs us 9 cents an hour. And we give it back to those health systems at $9 an hour. So it's like software margins, right? But it's like a 10x cost reduction. So think about that. And this nurse never judges you, answers every question. If you're old and you're bored at home, he'll talk to you forever. You can talk to him about the news. It's the smartest nurse on the planet. Creates an amazing sort of trust and experience in that regard. And so that's being rolled out. And here the key decision, by the way, was, do you trust this agentic nurse enough to be the pilot or the co-pilot? So we started by deciding, is this a tool we're going to give to nurses to make them more efficient on the phone, or are we going to just build an AI nurse? Given we had all the data, we were able to train a safe AI nurse that now can make the calls. If something is really severe, it'll get escalated, just like it would escalate to your supervisor. But this nurse is out there making all kinds of phone calls, in 20 different health systems now. The last thing I would say is, when you think about what we just did, we went from a shortage of nurses in the United States to having an abundance of nurse capacity with this technology. So then you start thinking about, how would you change the healthcare model? Would you just call every one of your elderly patients every day to chit-chat with them so they're not feeling isolated, and also make sure they're compliant with their meds? Would you really think about care models differently? So I think the impact is actually quite profound, what you can do, but you have to think about all these pieces coming together to be able to drive that.
A very interesting story. I heard of another story, which I think happens maybe around a year ago. People did a survey in UK. So they have real doctors, and then they have AI doctors, and then they selected a bunch of patients. So they talk to the real doctor, talk to them through text, and then the AI doctor talk to them. So at the end, about a few months after, then these patients were asked this question. Oh, first of all, can you distinguish who is the real doctor, who's the AI doctor? In fact, most of them can distinguish. So the whole thing did not pass the Turing test. But the second question was quite interesting. Second question they asked is the patient, do you prefer the real doctor or do you prefer the AI doctor? In fact, more than half of the patients said, I actually prefer the AI doctor. They're more sympathetic. They don't argue back. They don't debate with me. So a lot more sympathetic. But we'll come to that maybe later on in the conversation. But I think I want to get to the point, Hamid, you talk about how AI having an impact on specific industries. So David, if I can get to you, you obviously run a hedge fund. You already long time ago started to use big data models, analytic algorithm to already assist your investment decisions. So in your sense, how AI is having an impact on the investment business? Would AI be just co-pilot, or maybe one day, because it's all about pattern recognitions and etc. If you look at the gentlemen here, we did not talk about it before, but we're all in dark suits. And then the blue shirt guy always wear blue ties. The red shirt guy wear red ties. I'm obviously not
some
a
people wear no
person. So pattern recognition. So sorry, David.
Tech guys wear no ties.
Well, thank you very much. Very happy to be here. Well, let me begin by making a bit of a confession, which is, I have actually a PhD from the AI lab at MIT back in 1991. So I've been thinking about AI, most of my life. And today, you might wonder why I'll say to you that I'm very confused by the field. Because number one, when people use the word AI, they're referring to, it's such a generic term at this point that you don't really know what it's specifically about. And for example, I'll make two broad categories. There are forms of AI that are used to make predictions. There are also other forms of AI, which people call generative AI, like the large language models. And the sort of AI that went into the protein folding stuff, AlphaFold, is very different from the kind of AI that might be used to, at the company that you were describing. And so I think that the audience should just reflect for a moment. When you hear the word AI, it's an extremely generic term these days, and you really have to ask more questions about what exactly is the technology that you're talking about. The reason I start with this is because at 2 Sigma, for example, for 25 years now, we have been using data and pretty much every algorithm we can think of to make investment decisions. And we never really thought so much about, oh, is this an AI algorithm? Is this not an AI algorithm? We just use the best algorithms we can find to make predictions. We use the best algorithms we can find to optimize portfolios and to handle pretty much every aspect of the business. So when I look at AI today, maybe the conclusion I'll come to is that mostly it's a wake-up call to people that computers and data and algorithms are more powerful than people thought. And now everyone is rushing to figure out how they can use them effectively in their business. And I think that's very legitimate. So I see all of this, I'm going to call it, it's a hype cycle. I see it in a positive way because it is causing people to think very carefully about new ways to go about utilizing data and computers. And now, unfortunately, and here's where it gets a bit tricky, there is a lot of hype. A lot of what people say about AI may not really be true. There's a combination of underestimation of certain capabilities, overestimation of other capabilities. Fundamentally, this is occurring because it's actually really complicated and technical. This is not like regression. These are very, very complicated computer systems that you have to have a fairly deep understanding to get a realistic expectation about will it be able to solve the problem that you have. And I'll give just one example of where to be cautious. In the domain of predictive AI, for example, using it to predict the weather or using it to predict the price of an equity. Okay, that kind of makes sense because weather is predictable. It appears that the price of equities are predictable. But there are many examples of people attempting, in my opinion, to use AI to make predictions of things that may not be predictable. And so it doesn't even matter what the technology that you're using, you'll never be able to make that prediction. I don't want to go into examples now, it'll take too much time, but this is not a solution to everything. The AI that we have today is going to make people a lot of money. It's going to solve a lot of problems, but it's really not going to turn our society, it won't solve all of the problems of our society, far from it.
So no Skynet in your view, not yet?
Nowhere near.
Nowhere near, okay, great.
Well, if I might add, I get asked a lot, and I think on this very important point of AI being a very catch-all phrase, I get asked a lot about, is there going to be a return on AI that's going to be adequate for all the money that's been spending? My answer is yes, with an asterisk, because every board, every manager is reallocating money towards AI. It's their most strategic imperative, or top two. And it's so murky that you can justify a lot. And because it's so existential and fundamental, you can ascribe all your cost cutting to AI. You can ascribe your revenue generation as better than if we had not done it, and competing on that basis. And I think that's the wonderful wheel that technology is on to get people to spend more.
Right. So Devin, I think this is the best time for you to come in as well. So Insight Partners is a growth stage kind of investor. You always have to balance, I guess, growth, profitability, and all everything else. So in the case of AI investment or development, first I think Ken also asked the question, but also how do you balance between sort of innovation and potentially responsible kind of investment, not infringing consumers or other people's rights? Because I think David also mentioned this thing is very complex. Not everyone really understands it.
Yeah, so first, we are at an investment conference. So what I want to start with is a concept, which is that you can be incredibly bullish about a technology and not necessarily feel like the investment climate to invest in that technology at the time might be correct. And so we have the view right now that valuations are extremely overextended in AI. And if you look actually right now, and I was talking about this earlier with Hemant, I mean, the easiest way, there's only been one company that's made money on AI so far, and that's NVIDIA. Everything else is on paper, right? And if you go back, I'll use an analogy of the internet. Back in 1999, there's a whole universe of companies, eToys and Pets.com, and there's a list of 50 of those companies, and there's predictions about the size of the internet. The interesting thing is the size of the internet ended up being way bigger. None of those companies succeeded. But 15 years later, you have a whole universe of companies that didn't exist in 1999 that are actually trillion-dollar market caps today. So the point, and I'm going to answer your question, the point is, this is either a long-term market or it's not. And I think everybody on this panel would believe it's a long-term market. And so if that's the case, you don't have to make the bet today in order to still make very significant returns. The way, and now I'll go to kind of have the way Insight thinks about the market. And we really kind of break the market up into, and this is our own definition, kind of 5 categories. One I'll call like the infrastructure layer that sits under the LLMs. So that's companies like Weights and Biases and Hugging Face. Then you have the LLMs themselves, and OpenAI being the most prominent example, but there's obviously lots of others. And then you get to the applications, and we break up the applications into 3 categories. The first is, we like to call it making the impossible possible, and I'll come back to that. The second is kind of AI native applications that are built for some vertical, kind of like what Hemant was talking about. And the third, and this is kind of bridging a little bit of what Ken was talking about, is incumbents AI enabling their businesses, right? If you go to our view across those categories, the challenge of the infrastructure layer is it's likely when we get to LLMs that market's going to consolidate. So the number of customers that you're going to have as an infrastructure provider to that market is pretty limited. And that's the biggest challenge in that market. When you go to the LLMs, which we're not investors in, so far that does not look smart to not be an investor. But the reality is what we see is a significant risk of commoditization. And right now you've got one company that's got significant scale and revenue. And every week you can see the new update about the new model and the impact the new model has, and now Anthropic is a little bit ahead of OpenAI, and OpenAI is a little bit ahead of, so how all that plays out in an economic model in a very, very capital-intensive industry is really unclear. Third, the kind of making the impossible possible, an example in our portfolio is a company called Profluent, which is also focuses on this protein folding area. That's just something you couldn't do before. And so in our view, the things that you literally couldn't do before do have a little bit more of a moat than something which is an existing workflow that exists, which kind of takes me to the second category of companies, which is there are tons of AI native applications being built across lots of different markets. We probably see, we're doing this analysis recently, we saw at least 20 companies last year that this year you would not invest in just because of OpenAI's new model has gotten closer to their capability, right? And so you really have to find something where you actually have a true, not just software moat, but a data moat or a customer moat, which is why the thing Ken talked about earlier I think is super important, which is, and I'll use an example in our portfolio, we have a company called Central Reach, which is the leading provider of software to autism clinics. And autism as a condition is fast growing more because it's diagnosed. It was underdiagnosed, it's now diagnosed more appropriately. So what they've done is basically launched an AI function on top of their existing product. But what do they have? They have the leading market share of all the autism clinics already. They have the patient data for a significant portion of the. Now, if you were a new startup and said, I'm going to create this AI autism software model, that's great, but you don't have a single customer, you don't have data. And so you're seeing in a lot of markets people launching a company, but they have no customers. Now, the challenge is the incumbents are not always innovative. And so one of the things that, hopefully firms like ours do is work with our portfolio companies to make sure that they actually innovate on these categories. But having this moat, whether that be a data moat, a healthcare data moat, or some of the type of moats I've talked about, is critical. And I can tell you there's hundreds of companies that we've looked at that have no moat. And I think that there's going to be, you're definitely going to see a lot of write-offs in this category over the next 2 to 3 years. And I didn't hit the responsibility points. I just want to get to that quickly. I think when you think about, and unfortunately responsibility can be defined lots of different ways, so I'll just pick two. Kind of explainability, I'll pick that as the first one. And I'll use an example in our portfolio of a company called Zest AI that does credit underwriting for banks, right? The reality is when you think about credit underwriting, a loan officer has significantly higher risk of bias than a computer. They look at your picture, they look at your name, they have all kinds of inherent biases from just those two things before you even get to the credit file, okay? A computer, as long as you can explain why it's making the decision, is actually less likely to have bias. And so Zest AI has actually gotten a lot of push from even regulators who kind of want banks to use this type of software because they can explain why they rejected Ken's mortgage on his $500 million house in Hong Kong. I'm joking. So if you explainability, I think is really, really important in these AI applications, particularly when we're making a decision around some sort of human decision. I'll use privacy as another example. We have a company called Intensi that focuses on worker safety and that uses visual technology to kind of monitor work areas, construction sites. It only triggers when there's actually a problem. Now, if you think about the current system, there's a video trained on the worker the entire day, and it's being taped and monitored. As a worker, what would you prefer? Somebody monitoring you all the time or only monitoring you when there's actually an event? And so I think that responsibility, most of the time, responsibility comes up in the context of technology. I mean, self-driving cars is a great example. If somebody gets hit by a car with an autonomous vehicle, it's a huge deal, and it's on the cover of the New York Times for weeks. But 40,000 people a year die in car accidents, 70% of them because of human error. That gets no focus. So I think we have to be mindful of the fact that while responsibility is important, you also have to balance it against what is the positive impact that technology can make from a decisioning standpoint.
Thank you, thank you. Yeah, I think there's a very deep thinking also beyond finance and technology, right? It is about sort of technology, how it interacts with humanity and all that. But even before we get there, I think there's a question in a lot of us, our mind, is that as an investor, Ken mentioned, you don't look at AI and you just jump in, right? It takes different forms and shapes, and et cetera. But would you give sort of one advice to the people in the room here? What is the biggest risk when they make or when they considered investment into AI? What should they think about?
Investing in a company, I'm sorry, I just want to make sure I understand.
Investing into companies. Yeah, so who wants to start?
I think, look, the thing about AI is it has large systemic effects. So we have a series of companies, going back to the healthcare example. Some of them are creating more efficiency and eliminating jobs. Some of them are creating tools that allow us to create new jobs in the system. And any individual company might be in the business of eliminating jobs or creating jobs. So I think as an investor, when you're investing in a sector, you have to sort of think about it systemically and say, and be intentional about what is the world going to look like 20, 30 years from now. And if everything that we're investing in our core thesis plays out, is this a system on the other side that's inclusive? Health systems are the largest employers in every city in America, right? And if we put all the nurses on the phone, replace them with agents, and physicians become a lot more efficient, and all the payment stuff is done by AI, which is possible, and we said that's all we did, we would have actually created an unemployment problem in those cities. But in those same cities, we don't have enough people that take care of our elderly or our kids with mental health, so there's like missing workforces. So are you also creating those workforces? Because I think in the end, the systems and the companies in those systems that get to compound for a long time are the ones that are in the fundamental interest of society. So you do need to think about what are these ecosystems that are going to develop using AI in each of these industries, and are those sustainable, inclusive, or not?
And from the other end of the spectrum on, I think your question was, what's your advice for people wanting to invest in AI? I would say, first of all, be very careful in trying it at home. It's not easy, and as I think one of the other panelists mentioned earlier, it's already gotten to the point where the valuations are so full that, frankly, if you're not invested in AI or large-scale AI today, it might be prudent to wait, as was discussed earlier. I think the easiest way to invest in AI is to ride on the back of the top 4 or 5 hyperscaler companies that, or NVIDIA, which they all have a lot of runway. And I think the best vehicles to monetize, and it's mission critical for them. And by the way, they're spending massive amounts of money, but they can easily afford it. And then on the startup side, I think you got to go with professionals who, don't just invest in one AI company. You got to have a portfolio, and maybe a really wide portfolio run by professional investors like some of these gentlemen and some others who have lived and breathed it for some number of years.
I would add that I think probably in the end, most of the money that will be made on AI capabilities are going to be made not by AI companies, but by companies like Amazon and many incumbents and more of the traditional businesses, because ultimately this technology will allow them to operate more efficiently. It will make certain kinds of businesses more scalable. And so in my mind, AI is mostly an infrastructure capability that will be turbocharging other kinds of activities. And I think that ultimately that's where the opportunities are.
And I guess, and I'll tailor my question more towards application companies than kind of infrastructure, but I would just ask a really simple question. What is your competitive advantage in a non-AI world? If they can't answer that question, it's a problem.
All right, thank you. I have a question for David. You have a family foundation, as I understand, which says we're focused on understanding and shaping the impact of technology on society. So tell us, what do you mean by that? And in a way, how do we think about technology and society?
Thank you. I do. That mission statement is something that I adopted maybe 12 years ago, long before all of the AI topics that we're talking about here. My thought back then, and I think I basically was right about this, is that our society is becoming more and more technologically sophisticated. And so, putting aside AI, technology is advancing in general at a pretty rapid pace. It's a bit of an exponential effect, and the compounding is leading to increasing and rapid change. And I think the real reason people are confused right now is that the overall level of technical sophistication in our society is pretty low. And so if we're expecting the world to continue to benefit from and advance with AI and other new technologies, we have to make sure that people have a greater level of sophistication on how to use these technologies. And it can't just be limited to a small group of people. If it's limited to a small group of people, we're probably not going to get the outcomes that we want for a lot of different reasons. So the mission of the foundation, and I think this is a big challenge in every country of the world, is how do we prepare people for more rapid technical-driven change? And I'll just give one example. 30 years ago, when you went to school and you got a job, you pretty much had the expectation that your career and your skills would probably be good for a lifetime. And today, maybe they're good for a handful of years. And so the world is not really set up for rapid change, even in, for example, education.
Right, that's great. So I guess that I think it also summarizes quite well, part of what we want to talk about is that, while it's very exciting to see how technology investment, AI, can help, a few shareholders get rich in the shortest possible time, but we also want to extend the question beyond and ask the question, how does it bring, better and better life and more sustainable kind of benefits to the overall society as well. So with that, let's give a big hand to our panel.
Thank you very much to our wonderful moderator, Mr. Chung Leung, and to all our panelists. Gents, could you come to the front of the stage for a group photo before you leave? Wonderful. Just step forward a tiny bit. Excellent. So we have our photographers at the front. And then the photographers at the back on the left. Those are our media friends. Great, thank you so much. Thank you again to Chung Leung for moderating, and to Ken, Devon, David, and Hemant for that great panel. Oh, there's a little selfie going on too. Thank you again. Well, that brings us to a close for today's event, and indeed the 3-day Global Financial Leaders Investment Summit. I'd like to invite Mr. Eddie Yue, our host, the Chief Executive of the Hong Kong Monetary Authority and Chairman of the Hong Kong Academy of Finance, to wrap up the event for us. Eddie.
Well, I know it's about lunchtime, so again, I'll be very brief. I just want to thank all the speakers today for the very, very stimulating discussion. I myself learned a lot from it, and I hope that you do too. And what I like about the summit is not really just about the discussions today and yesterday, which are really great, but also the vibe that we've created both during dinner and during coffee break, that there are lots of side discussions, side dialogue around the summit time. And I was told that the summit is now an anchor event in Hong Kong and the region, and there are like about 15, 20 events taking place either before or after the summit. So as I said yesterday, we're going to do it again next year. The 3rd and 4th, the welcome dinner will be the 3rd of November. The summit will be on the 4th of November. So everybody mark your dates, and we'll be back. I'll see you next year. Thank you so much.
Thank you very much, Eddie. So you heard it here first, 3rd and 4th of November. We promise we won't have any typhoons somehow. But thank you so much for joining us today, and enjoy the rest of your afternoon. Thank you, everybody.